I think it's just going to take time for people to get used to higher rates.
5.25 is enough. I don't think we need to go much farther than that.
If we're going to have a recession in the second half of the year, it's going to have to come from the consumer side of the market.
Economists have us starting a recession in just a few days in the third quarter. You don't see that in the earnings forecast.
The Federal Reserve has basically told us the only way out of the inflation conundrum is to have a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. It's panel day in Portugal. We'll be there to watch it with you. Every central banker on the planet speaking. Is there any central bankers? Do we have Fed presidents and governors speaking at the panel today? Well, can we get them all there to talk?
I think that all will matter. It'll be Fed Chair Jay Powell and also, of course, his counterpart, ECB Christine Lagarde.
I know you're going to review this in the brief, but I'm looking right now at the fallout of a central bank panel in Portugal on the markets. And it's fascinating. Kit Jukes with an absolutely brilliant note this morning, hearkening back, Lisa, to 2004, 2005. You're going to love this, Lisa. The vortex of instability. Will they create a vortex of instability, as Albert Edwards talked about years ago? This was a very famous moment just before the crisis. And there's that tension out there as central bankers speak today.
Are they going to go too far? That is the key concern, especially in Europe. The U.S. has possibly a different situation where Fed officials seem to be much more concerned about some sort of downturn, although we have all of these upside surprises in the data. So maybe we'll get a different tone today from Fed Chair Jay Powell. It really is in Europe. Are they going to hike into a downturn that we're going to see increasingly on the margins, particularly in manufacturing? Can
we point out that the Standard & Poor's 500 futures are 4410 as we worry about central bank discussion? And I think and if John was here, John Ferro on assignment, folks, if John was here, he would say, look at Trichet and the mistakes made of raising rates years ago. And will we redux that again with Lagarde and the ECB? It's going to be fascinating.
Right now, what we've continued to see is just people shrugging off the concern about central banks in the U.S. This is more than a tech story at this point, because tech has actually stalled out, as our next guest pointed out, just as he got on set with us this morning. So what's driving that? Is it underlying growth that we're seeing in the housing market, that we're seeing in areas, even in manufacturing?
Well, it's going to be interesting to see. And the markets here are pretty much stasis. But can I point out that within the global slowdown, into the data check here, Lisa, I had a 67 on West Texas Intermediate walking in the door, 68.16 on oil, and renminbi has very quietly gone out to new. I can round it up now to 7.25. These are quieter stories as everyone's focused on Portugal in your 9 o'clock hour this morning.
This, to me, is one of the big question marks. How much of a downdraft is the China slowdown, which you're seeing in the UN, which maybe you're also seeing in crude, which maybe you're also seeing in copper? How much is that really featuring into the fear of something that's less sustainable as central banks raise rates? And that, I think, is really what you're pointing to with some of these other indicators.
I think the thing about this panel today, it's important, and we learned this yesterday with Francine Lacroix and Guy de Gopinath, that it's very important that they have this fancy pastry in Sintra that we mentioned yesterday, which is a creamy almond coating with a butter overlay as well. That'll probably make for a more collegial panel.
News you need to know.
It is.
And that's basically what we're going to be looking for, is what kind of snack
How many people are on the panel? Seriously, is it 4?
It's 4 people on the panel, and that's going to be the key thing. The central bankers from the ECB, the Federal Reserve, the Bank of Japan, and the Bank of England.
The new guy from the Bank of Japan.
He's going to be there as well. Okay, so that's going to be interesting to see. I'm actually very curious. Andrew Bailey, I think, is going to be front and center at 9:30 a.m. How far they can go. You're seeing 2-year gilts. Just the yields on that spread to the highest that we've seen in a long time. And this is really a concern, especially given the interest rate sensitive nature of their central banks and, frankly, their housing market.
Well, it's going to be interesting to see. I mean, this panel here, Lisa will have that on Bloomberg Television worldwide here in the 9 o'clock hour. And it's going to, I just don't know what to expect. And I also don't know, will it be market moving? I don't know.
I don't know either, and I think a lot of people are watching that. The other things that people are watching, they're watching what we get from the stress tests after the bell at 4:30 p.m., and even more importantly, possibly, will be NVIDIA earnings that come out. And that's the other story that really is dominant today, is renewed concerns that President Biden will ban exports of specifically higher tech AI-related chips to China, and you're seeing NVIDIA come off quite a bit on the heels of that because about a fifth of their business is selling to China. So to me, given how much this has really dominated the rally year to date, that's going to be something we're watching as well.
NVIDIA, I agree. It's sort of the beginning of earnings season now, almost with what they've done with the tech ballet as well. With the data here, red and green on the screen. What an odd day yesterday and an odd week. We will dive forward here and try to glean from the charts what it all means. Christopher Verone joins us now. Head of Technical and Macro Strategy at Strategas. It is a Baird company. Christopher Verone, thank you so much for joining us. Which chart matters right now?
I think there's nothing more important in the world right now in terms of what bond yields do over the next number of weeks here. I mean, 10-year yields have been chopping basically since last October. This is going to resolve itself very soon. We're simply running out of real estate on the chart. I think you start pushing above 390, 395 on 10s. That's a big deal. I think it's a big deal for multiples. I think it's a big deal for the growth value equation. And Lisa, as you point out, very quietly the last week or so, there's been some stalling in tech. And I wonder if that's some reflection in where rates go from here. I also think the weakness in utilities might be a reflection of where rates may go from here. And the move in UK has been absolutely explosive here. You have 2-year gilts and 10-year gilts basically back to where they were when all these revelations about LDI and British pensions were revealed last fall.
Can you judge technically, and we had a guest yesterday that talked about this, how what we really need to see is the high 2-year yields come out to a high 5-year yield. Do you see within the charts of spreads, the charts of an actual single yield, where we're going to broaden out these high yields into a higher yield regime?
You know, what's interesting, we always look at this relationship between twos and Fed funds, right? And twos have largely traded south of Fed funds since, call it, February or March of this year. They're starting to creep back up there in terms of reclaiming the bar of Fed funds here. And, you know, if you look at who's raised rates recently, the Aussies, the CADs, and UK, what's happened in all those markets? They've softened. And what's happened with the banks in those indices, they've softened as well. Canadian banks, Aussie banks, UK banks are all pretty soft here as those central banks have hiked over the last several weeks.
There's a real tension heading into this 9:30 a.m. panel of how important the central bankers are in determining what happens next in markets. There was a brief second where people thought maybe we have moved beyond central banks and we're moving to fundamentals.
God willing.
Are you saying that that's not the case?
I don't think it's the case yet, or at a minimum, I think the message or the interpretation of the bond market to all of this is still paramount in our thinking about what the second half of the year looks like. But, you know, Lisa, as you point out, the trend here is still the trend, and the trend in stocks is still up. There are areas of weakness and there are pockets that may get weak, but in basically broad aggregate here, the trend in stocks is up. What I want to watch as we think about the second half of the year, we've seen some modest broadening over the last 2 or 3 weeks. Does that stall or does that continue? We're sitting here today with about 60% of the S&P above the 200-day moving average. That's a reading that ordinarily wouldn't worry me that much. It's just unusual in a first year off a low that we're not broader. Narrow markets are common, but they're common late. They're not common early in a new advance.
You mentioned that we have seen this stalling out in the tech trade. There have been a number of downgrades from banks saying perhaps it's gone a little bit too far. Are you saying it's more related to the yield story and the waking up to an old paradigm that we saw a whole 6 months ago that people had abandoned when we had the no landing, the soft landing, and the immaculate disinflation of, say, February?
You know, it feels like a different world ago. We spent basically 21 and 22 thinking the world had changed and we were on the cusp of some big regime change for that view to be massively challenged over the last 3 or 4 months. My suspicion is if we really get rates up here, and I'm talking, say, above 4 on 10s, maybe above 410 on 30s, new highs on 2s, you're going to really begin to question some of the valuations that are put on these tech names. And I wonder if that's why there's a hint of them starting to stall here. It's not everywhere. Apple made a new high yesterday, but quietly, Google's come in here, AMD's come in here, Microsoft has softened a touch. They've all ridden their 50-day averages all year. I think those would be very big levels moving forward. And if you want to look at a test, this is a different sector, but use this as a test. The European luxury names, Hermes, LVMH, etc., they've all been very tech-like this year. Those have actually started to stall the last 2 weeks. I think we're going to learn about other corners of the world from how those stocks respond going forward.
Bloomberg with a great story today on, is it Louis Vuitton?
About how it's ESG. It's the latest ESG stock,
as well. Technical analysis is about looking at the past and learning lessons. We came off the mat 73, 74. We had a nice leg up. And then in December of 1975, we discovered a second leg up in the market. Can people like Chris Verone discover a second leg before it happens?
When I think about markets, I don't really operate in the world of levels. I operate in the world of what is the characteristics of a certain advance. And I think on balance, when you look at this current advance, the leadership is still pretty risk-seeking. We see it with industrials. We see it with discretionary better than staples. So I would use those characteristics to say nothing really meaningful has changed yet. I think a shift there would cause alarm, but I'm not seeing that here yet. And, Tom, you bring up this 1970s period. It's often referred to as this 10-year range. I kind of reject that. It was periods of bull and bear markets.
Yes,
it was 2 years up, 2 years down, 2 years up. It wasn't 2 weeks up, 2 weeks down.
Agree.
So this idea of the 70s being a range, I actually don't think is very accurate. If you want to look for a range, I think there's some parallels to this market. Kind of post-World War II, 45 to 50, I think is very interesting. Also a period where all the economists kept thinking recession was coming, and it never came. Interesting there.
Given that fact check, do you reject this idea that the past indicators are no longer working, that the models are broken, and that technical analysis doesn't hold the same kind of clout?
It's funny. I suppose it's your definition of what technicals is. We wake up every morning and we ask ourselves the simple question, does the market agree with the consensus? That's my definition of what technical analysis is. Anytime in my career where I've begun to question whether the indicators are valid anymore in new regimes, they're about to become very valid. So I would just keep that in mind here. Put that in context of some of the tech names. 2, 3, 4 weeks ago, we got what I would only characterize as blow-off-like volume in a lot of these semis. And what do we know historically about blow-off-like volume? It very rarely marks the top, but it can begin the sequence of putting in the top. And you were doing about a month ago, you were doing 4 or 5 times average weekly volume in NVIDIA, AMD, Avago. So some of those makings there are a very blow-off-y type volume.
With all your study of charts and the in and out and being bullish, being bearish, does market timing work? If I'm in cash, can I figure out when to get in efficiently, productively, effectively?
I might replace the phrase market timing with trend following. I think trend following works. I think we can do a pretty good job. I think all of us can do a pretty good job of getting that middle 70 or 75% of a move. I haven't met anyone yet who's particularly good at the turns. That middle chunk, we can. All the money in this business is made in the trend, not at the pulse. Right? We can, I think, play trends, and that's what we've tried to do.
I set him up with that question. I knew what the answer would be.
I know, Tom. I think the audience did too. I think everyone knew that what the answer was going to be.
This is the gospel of Verone. I mean, there's no other a way to put it. Chris Verone, thank you so much.
Thank you.
I came out of that, you're a bull.
I think it's too early to back away from the trend. You can put your guard on for some things to change, but watch rates here. Rates will decide the second half of the year.
Chris Verone, thank you so much. Greatly appreciate it. Lisa, what do you see in rates this morning before this panel at Sintra? I take your point that maybe we'll get the most out of Governor Bailey here. I don't think he's going to declare victory. Remember
that was
a couple weeks ago.
Well, we heard that from Gita Gopinath, that they have the hardest task here, and I think everyone would agree with that. What we have seen is kind of stasis in markets ahead of this panel. We don't know. We don't know how far they're willing to go and what they can say to convince us something different than what we already heard.
Please stay with us. We'll have our coverage here from Centro. Francine Lacroix leading our coverage in Portugal. Most interesting central bank. It's like one glorious press conference. Maybe McKee will sit in the back of the room and ask a question here late in the panel. Red and green on the screen. Futures at -7. Stay with us. This is Bloomberg.
What we've seen in the actual data has been a lot of resilience. We've actually seen that stretch of a strong labor market improved due to the very large increase we've seen in participation of working age Americans. And so there are reasons to think that we are going to continue to see resilience against a backdrop of what we have referred to as more stable economic growth.
I'm not sure I've ever seen that. That is the vice chair speaking differently. To shift from a vice chair of the Fed to National Economic Council Director for the President, Lyle Brainerd. Lisa, in all my years, I believe I've never seen someone try to make that shift.
And then have such an important role at such an interesting time where we're expecting recession and still expecting it. And still expecting it, and it hasn't come, and all of the data seems to point to resilience. Did you see the consumer sentiment yesterday?
Yeah, actually, it was stunning. But there's Brainerd, and as a vice chair, you're hesitant, and you have to wait for white smoke to come out of the chimney, and you're looking at dots and all this other stuff, and then you go over to the White House, and you have to promote optimistically an optimistic message. What a shift rhetorically.
Although, from Biden's perspective, it would probably be better for there to be a short and shallow recession now than right as we head to the polls.
Yeah, well,
and that, I think, is one of the tensions.
Yeah.
So if she's actually trying to, thump the cause, that's really the tension right now.
Lyle Brainerd talking about the good economic data Lisa observed yesterday, and we saw it within a good stock market yesterday. The levels closing right on 34,000 on the Dow, SPX, a little bit under that 4,400 level. NASDAQ really with a life of its own yesterday. We're looking at the currency space. I want to take 2 seconds here, Lisa. I think this is too important before the central bank confab in Portugal. DXY stable, but lots of underpinnings going on. I'm going to go to euro, yen, Lagarde, and who's the new guy at the Bank of Japan? Help me here.
Kazuo Ueda.
Ueda. Lagarde Ueda. The Lagarde Ueda pair is up at a 158. Strong euro, weak yen is one thing I'm watching.
And it has been a weaker yen pretty consistently because they have doubled down on this message. Even as we see inflation expected to surprise to the upside in Japan and creep higher, despite this call that they want that, and the rest of the world is battling the same kind of trend. It's very counterintuitive.
All this wrapped around the elephant in the room, which is Chinese weakness, certainly business and manufacturing weakness, and part of that, the political tensions between the United States and China. Before this panel and the 9 o'clock hour, we're briefed by Wendy Schiller of Brown University, director at Taubman Center for American Politics. Professor Schiller, thank you so much for joining again. Our Anne-Marie Horton reporting that Janet Yellen will exit to China here early in July. What can be the goal of a Secretary of Treasury to continue to rebuild, if you will, that permanent codependency we have?
Tom and Lisa, good morning. This is a really strategic move, I think, to shore up the economic relationship between the United States and China, but also to continue to send signals about the United States' willingness to engage with major powers that are not Russia. So we've got Modi and the Modi state visit, rolled out the red carpet, ignored some of the human rights issues in India, and now going to China, our top economic person, Secretary of Treasury. You can, fight about the Federal Reserve and Treasury, but she's certainly extraordinarily prominent in our economic infrastructure, and sending her or asking her to go to China reminds China that we are this stable, relatively stable, very strong economic power. And it, again, sends a geopolitical message to Russia that the United States is trying to double down on its relationships with the two other very strong nearby partners to Russia.
Wendy, how much is that message undermined by the news this morning that the U.S. may ban exports by U.S. chip makers of more advanced artificial intelligence-related technology to China at the same time that they're trying to create some sort of stronger relationship?
Well, there has been a theme for quite some time, actually, really very pronounced under the Trump administration, but certainly continued under Biden, that, intellectual property theft or spying or trying to sort of steal U.S. technology, this has been a sort of a mainstay for quite some time in U.S. policy. It's quite consistent. And, the Chinese have not been as responsive to U.S. complaints about this, both from the government's perspective and the private industry perspective in China, or quasi-private industry. And they just want more response. So, you can't keep stealing things from us. We're going to crack down on on your companies. We're going to launch charges, and we're going to basically ban exports of highly sophisticated technology until we can get a handle on how much you are literally stealing from us. And that has been a consistent message through the Trump and the Biden administrations.
We're seeing NVIDIA lower today. It gets about a fifth of its revenue from China. We'll be talking about that throughout the show. We started talking about this panel coming up of central bankers. And Wendy, we heard from President Biden yesterday as he was talking to donors that he thinks the U.S. is going to avoid a recession. And he was talking about the positive data that we've been seeing across the board. Is this a good thing for him, considering it could push any kind of downturn out to right around the election?
Lisa, yeah, your point is so excellent about the timing of when people perceive a recession versus when we're experiencing a recession. There's a famous political scientist, Edward Tufte, a model from the 1970s, that says, whatever's happening in January or February of the election year really has a strong effect on who wins the election in November. I think that timing has shifted quite a bit, and I think that people's sentiments are also led by elites much more than they were maybe 40 years ago. A broader swath of people pay attention to more popular sort of news about the markets and about the economy. So it's really unclear when the best timing, if there is going to be a soft recession, would be for Biden. But you're right, before December 23 is certainly much better than June of 24 for President Biden.
Wendy, I thought of you yesterday when I saw a British newspaper leading their website newspaper with a poll on the Vice President of the United States. Give us the historic perspective, the so what, if you will, that a vice president does poorly in the polls. Is there a so what to that?
Yeah, well, it's sort of a new phenomenon, actually, although vice presidents have been traditionally the people that run for president. So why we haven't done more polling historically on the popularity of the vice president is anathema to me because, with some exceptions, Dick Cheney, for example, and Joe Biden in 2016, usually the VP is the leading candidate and runs for president. So we want to know how popular they are. So this is a new phenomenon. There's not that much history to compare it to, but clearly we have to figure out, if we are political observers, how much voters really care about the vice president of the United States. Will this really turn their decision that Kamala Harris might be president, given Biden's age? But the same thing will be said of Trump's vice president. So I think there will be a far deeper and more sophisticated discussion of the VP role for both. If both of those are lead candidates, then in 24, we're going to see much more scrutiny on whether Americans are willing to accept the VP as a potential president on both sides of the political aisle.
Wendy Schuller, thank you so much, with Brown University this morning. I was thunderstruck by that, Lisa. It's a Telegraph in London. It doesn't matter which paper it is. But in London, they're leading with a poll on the Vice President of the United States. Without question, I've never seen that.
There is this belief that Vice President Kamala Harris will have to take on a much greater role in this election due to the president's age, due to questions about his ability to fill the entire tenure of his term. And we saw that with the White House Correspondents' Dinner, where a vice president, Kamala Harris, was the first to sit on stage with a sitting president for that, going back to 2016.
Time? I did not know that.
It was going back a number of years. There was a theory that this was to sort of emphasize her position heading into an election where suddenly the succession becomes a much bigger question.
That's going to be interesting to see, to say the least. Can we go back here to this panel? And I'm going to look at foreign exchange, and I'm sorry, I don't know what to do here. There's just massive ambivalence here in the foreign exchange market with dollar on. Sterling is, I guess, what I'm watching more than anything, Lisa, 127.07. Again, it's a churn waiting for the news. I mean,
it's a churn except for the Chinese yuan, which is weaker decidedly across everything. And that is the one theme as we look to how they can bolster that economy.
We'll have to see. Red and green on the screen here right now. Futures at -7. The VIX, wow, 13. I'm still not used to this. 13.80 on the VIX. Coming up on the Events Center, Veronica Clark of Citigroup. This is Bloomberg. Good morning. Bloomberg surveillance. Jonathan Ferro on assignment. A lot of mystery about that. It's like a British thing. It's
not a mystery.
Time.
He's on vacation.
Time off. It's like
it's a good thing.
3 or 4 weeks. It's like a sabbatical.
It's a good thing. I think everybody.
Have you ever had a sabbatical?
No, I have not.
I've never had a sabbatical.
No, I've been working since I got out of college.
We should work on that.
Yeah, I think so too. Go on a collective surveillance sabbatical.
Three of us take rolling sabbaticals here into the end of the year. John Ferro returns here at some point. Lisa Abramowicz and Tom Keene again. Lisa, with this important centric coverage. Look for it at 9:30 a.m. This morning. Lisa, what's that going to be like? I mean, they show up and I guess Miss Eisen's leading the way, and they're going to really kill themselves not to say anything, right?
I feel like Jay Powell's going to sit there and be sitting pretty, and he's going to sit there and be like, we've got it kind of under control, and soft landing and disinflation, and we're seeing good things, blah blah blah. Yeah. And then ECB's Christine Lagarde will say that's not where we're at. We're in a much different position. We're going to stay hard. We're going to keep raising rates and keep doubling down. And then you're going to have Andrew Bailey being like, we're having a really tough situation, and then you're going to have Ueda, who's just going to be very awkwardly sitting there saying, we're very happy with yield curve control. And that's going to be the dynamic of the entire meeting.
We've tried to bring you folks some of the dynamics, as Lisa mentions, of the Bank of Japan. It's distant. It's around the world. What's the so what for American listeners and viewers? And the answer is it really, really matters, according to the pros, and it links directly into the American economy. Yen 144.08 just refuses to go stronger, a lower number. And for that to get out to 146 or 148 would be a challenge for the Bank of Japan.
It's going to be interesting. This particular panel, I feel like Fed Chair Jay Powell is probably going to have the best situation because they are further along in some of the rate hikes, or so people think. Veronica Clark has been pushing back against this idea at Citigroup that the Fed is done, saying the timeline for a potential recession has pushed out further out as activity and jobs data continue to surprise to the upside. A sharp slowdown in growth remains a risk, but stubbornly high underlying inflation is the current reality. We continue to expect the Fed to raise policy rates by 25 basis points at each of the next two meetings. And that is the distinction between the Citigroup view of the world and the rest of Wall Street, Tom, which really has pushed back against the idea that the Fed has to go that much further.
Can we be as bold as to say, like Ilarion and Dudley, Citigroup's been out front on this for 18 months, maybe it's 14 months, but I think Citigroup has been way, way out front on this.
And here to take a victory lap is Veronica Clark, economist at Citi, to sort of extrapolate out how far the Fed can raise rates. Is the market accurately pricing just how hawkish the Fed needs to be in light of the recent strength?
Yeah, I mean, it's not over until it's over, of course. But I think the market is more fairly priced at this point. We're expecting a hike in July. We're also expecting a hike in September. The market is pricing that hike in July at, to a pretty, large degree. I think that July hike is a relatively low bar. And then after July, we'll, should see still some strong inflation data. And then that gets us to the hike in September. But for the market, it's just going to take time to see that data to price it.
What are the tensions right now, Veronica? As a lot of people are saying that the tightening in credit conditions has not been nearly as significant as people thought because of how contained the 10-year yield has been, longer-term yields. How much do we need to see those yields creep higher to achieve what the Fed is going after?
Yeah, it is an interesting dynamic where, we have had a tightening in credit. Obviously, yields are higher, but they haven't continued to move higher. And this is actually an interesting dynamic that we're seeing in the housing market now, where, of course, mortgage rates will be more dependent on those longer end yields. And they've been relatively stable since the last half of last year. And that means that we're actually seeing a pickup in housing activity again, in housing demand. You can see these dynamics if you're not tightening credit conditions more.
I look, Veronica, at where we are, and I really want to fold it in this panel this morning. This panel, I think, is going to be a snooze fest, and I'm usually wrong, to be honest. I think there's going to be some interesting complexities out of it as well. From where you sit and with your global mandate at Citigroup, how removed is America's exceptionalism, our monetary exceptionalism, from what everybody else is doing out there?
I don't think too removed, actually. I think, it's a struggle for a lot of these, global central banks, obviously, to get inflation lower. And I think the Fed can maybe learn from some of these other banks. Of course, we had Bank of England hiking by 50 basis points, Bank of Canada that, tried to pause their rate hikes and then also got this rebound in housing activity and inflation that didn't slow enough and had to restart hiking rates again. So the Fed can kind of learn from some of these central banks that it's just a really hard job to get inflation lower, and you might think that you're close to the end, but there are still those upside risks if you're still well above target.
Well, review with us, given the Citigroup call, the trajectory that you see on rates linked to inflation? Is it like 5%, struggle through 4, or do we rapidly come down to 3 and then it's a struggle to 2?
Yeah, we're increasingly thinking about these scenarios where inflation doesn't slow as quickly as in our forecasts or as in the Fed's forecasts. We have penciled in, a mild recession for later this year, early next year. Risk that could be pushed out more, because if you're not slowing activity enough, if you don't get enough of that loosening in the labor market, then it can look like inflation's coming down. That might be what the second half of this year looks like. But then you can get some kind of re-acceleration next year, or it doesn't come down enough. Because for the last 2 years, core PCE inflation that the Fed will target has just been very stably 4.5% to 5%.
Veronica, what do you think we're going to learn today from Fed Chair Jay Powell, from some of the other central bankers in Sintra?
Yeah, I don't know if we'll hear a whole lot new from Powell. I think it's a relatively hawkish message still. We heard from him last week, of course, in congressional testimony. This is maybe a bit better of a forum if he wanted to, give any kind of guidance. But there really just hasn't been too much data since we heard from the Fed a couple weeks ago. So I don't expect that he'll sound too different. Probably just hammering in again that the median Fed official still sees rates moving higher by 50 basis points this year.
How divergent do you think the messages will be from central bankers that are fighting what a lot of people say is a very different inflation fight depending on the nation?
Yeah. I mean, in terms of messaging, I don't think really any central banker has, the ability to not, really hone in on high inflation. That really does have to be the message, whether inflation is caused by, different factors. It is still too high everywhere. And just on a credibility messaging standpoint, that is the goal of all central banks, is to have lower inflation than we are now.
Veronica, thank you so much. Veronica Clark of Citigroup with us this morning here with a steadfast call. They haven't budged one iota, Lisa, have they?
And that's been a consistent hawkish theme, that the Fed has to do more. And they have been right. They said this even through the banking crisis in March. And right now, the market is joining them. That said, rate cuts have been priced out, the probability. But still, people see the first half of next year being a retreat by central banks, by a retreat by the Federal Reserve in the face of likely weakness. And
some of this is the belief of a labor market that continues. I mean, that we get outlandish 4% unemployment, 4.5% unemployment. I mean, that's the game, right? It hasn't broken.
It hasn't broken. And the other aspect of this is the credit impulse and what happens with the banks, and whether we are seeing more restrictive credit conditions than many people previously thought. On the margins, that will percolate up in a more material way.
Joining us now for a 2-hour conversation, because there's a lot to talk about in our world, is Bloomberg hypothetical scenario correspondent Sonali Basak here on the stress tests. To me, stress tests are a snooze fest, but I see in February the Fed's model here for stress tests is a 10% unemployment rate. Why are we going through this exercise today at 4:30?
I think the expectation here is to test harder, faster as we get into tougher economic conditions potentially. But to the point that you're making here, a lot of the criticism has been, where has the Fed been in testing some of the scenarios that actually had gotten the banks in trouble? Another part of this test that I think is even more fascinating is the trading scenario here, this exploratory market shock. And the reason it is interesting is because the Federal Reserve is going to be changing its stress testing standards, and the expectation here is that trading desks in particular in the future will be facing tougher capital requirements. What does that mean? It has real business model implications. You're seeing trading desks and investment banks kind of hold up better in the market relative to consumer banks that are worried about this economic environment. But if the Fed is stress testing that more rigorously, it means the returns can't be as exciting in the future.
On radio, we're showing up here. Sonali put together this gorgeous 35 logo chart of banks. Lisa, I don't see SVB's logo up there
right. Well,
on the wall.
This is the biggest banks, and that is one big question mark with the stress tests. How applicable are they to some of the regional banks, especially if they rise to, I don't know about systemic, but something of concern for the Federal Reserve? You talk about the nature of the stress tests, and I agree with that. This idea, are they going to talk about what happens if deposits all go away, right? How do they stress test that? What are the likely implications of the results? Is it going to be that they have to raise more capital? Is it going to be that they have to increase their debt issuance? What are you expecting?
There is an expectation out there that more banks will go to the debt markets, really, to kind of boost their buffers here. But there's also an expectation that buybacks, dividends can be pressured in the future. And not just for the biggest banks. There's an expectation that the big trading desks, as we were talking about, might be more pressured in terms of the rate of change here than perhaps the rest of the consumer banks. Actually, Bank of America is expected to have a little bit of an increase relative to before. But the mid-sized banks here, because the bar today is $250 billion and above, those mid-sized banks are really going to be more pressured when it comes to capital return than the big ones.
To Tom's point, is there any discussion about stress testing some of the smaller banks, particularly in light of what we saw in March?
Well, what we had was Fed Chair Powell confirm that they really want to lower that bar to $100 billion. And that is kind of the political uproar, isn't it? If these smaller banks face tougher stress tests, then those compliance costs go up. And there are ripple effects here in terms of how these banks are spending money. There's another interesting thing that's happening here is a greater scrutiny on bank mergers by the Biden administration from the Department of Justice, from the FTC potentially. And if you have that bar lower to $100 billion, does that incentivize banks to want to merge way above that bar?
The history of this, folks, and I remember the clearest memory is standing next to the Bloomberg terminal the first time we did stress tests with the great Otis Bilodeau. And Otis and I are standing there, and, you know, frankly, we're navel-gazing, folks, because we're like, okay, what's the so what? Because this has nothing to do with the reality of how banks fail. Mm-hmm. We have just had a 6-month disaster. Did you see PacWest, their chart? We've had a disaster in the banks. Mm-hmm. That has nothing to do with these stress tests, right?
I will defend the stress tests pretty strongly, however. You know, I think about what Marty Chavez had said, former CFO of Goldman, now at Sixth Street. And he has not only said, had the stress tests not happened, you would have a lot of runaway activity by the banking system. It forces both the banks and the regulators to just check in and make sure.
Did we check in with the San Francisco banks that were giving out 1% mortgages to take in gazillions of dollars of money market funds?
It's not a complete system.
Why isn't it? That's the key question.
And I think what's happening now is that kind of struggle here on what is the right scenario. You can slap more rules on the banks, but the supervision is also what failed on the back of this,
That's what I was going to say. It's one thing to game out every situation under the book. It's another thing to actually take action to do anything about it. What are they going to do to shore up some sort of more consistency and supervision? Is that going to be part of the discussion today?
Well, I think yes, but I think part of the problem here is it will take years to get there. And by the way, we're getting to another political cycle very soon where some of these new tighter rules could face a lot of rollbacks in any potential future changes.
Help me here, Lisa. I got the surveillance cork in my mouth.
Why are you grunting? I don't even know. I don't even know why.
Okay. Let me cut to the chase. Worldwide, I think Colin and Sparta can say that. I can say this on the radio. This is total hogwash. This is just
what is this?
Cover your ass. Regulatory idiocy.
What would Chair Keene do?
Chair Keene would broaden it out to the keyword Lisa Abramowicz just said, which is supervision. And I adore Mary Daly. She's my favorite Fed official. Where were the San Francisco banks during this charade that we had in banking out on the West Coast?
Well, then what is hogwash? Is it the stress tests?
That it's impartially and conveniently applied to people who can pass the stress test.
I feel like Tom Keene is going to get a call from Jamie Dimon right after the show.
No, but
what does this do to James Dimon? That's a serious question.
Well, a lot of people think it's going to do absolutely nothing because he's already built up his capital buffers and then some. So really the question has to do with the smaller banks that are less subjected.
Absolutely. And so the mid-sized banks are the really ones. And, you know, there's this worry. Raj Cohen worries about a barbell system in the United States. What happens to lending then if you only have the small and you only have the really big?
Across the Bloomberg terminal, Ken from HR says, Tom, we'll see you at 10:05. Shadali Basak, I learned a lot there. That was great. 4:30 today. Stress tests will be stressful at 4:30. Stay with us. Kathy Jones on bonds. We'll do that at 7:30. Good morning.
I think that July is a fait accompli. It has been indicated, and it's quite clear. September will depend. What are the factors that are going to determine what happens in September? I think that some of these downside risks have started to materialize and are becoming much more visible. So, this is something that we'll have to revisit in September.
He speaks sometimes with Madame Lagarde, the vice president of the European Central Bank, Luis de Guindos, at Sintra, at Portugal. Lisa Abramowicz will have complete coverage of the panel today at 9 o'clock. It is 4 central bankers. I guess it's going to be a snooze fest, but guess what? All my radar's up. I really wonder there'll be 1 nugget or 2 nuggets.
I don't think it'll be a snooze fest.
Really interesting to see.
Honestly, even the dynamic between Ueda and the Uber hawks on the bench, Christine Lagarde in particular, is going to be fascinating. Completely divergent monetary theories, but then also Andrew Bailey on the hot seat at a time when those yields on gilts are just surging.
I'm not going to mince words. You alluded to this yesterday. So different from Jackson Hole. This is the ECB confab, which is much more non-academic, much more visible, I would say, with authorities trying to manage the message forward even more so than the choreography that we see at Jackson Hole.
Well, even the place, it really highlights the differentials here.
Yeah.
One is a holiday spot, beautiful palaces, and the other is the rugged Grand Tetons in Wyoming, where you go and stay in rustic digs and focus on big thoughts.
I'm going to give you one data check right now, red and green on the screen, and that is the real yield. The 10-year real yield is of major focus. Chris Verone and I were talking off air about it. 1.56% on the real yield. It is really buttressed up against the idea, as Veronica Clark of Citigroup mentioned, a newer, stickier inflation regime. Right now, in a summer of discontent for global Wall Street, we can talk about sundry layoffs, except they're of a magnitude that is extraordinary. No surprise with UBS taking out Credit Suisse. Jan-Patrick Barnett has been wonderful about this in Frankfurt and covering that. Yeah, when you were in the banking business, were you ever laid off? Were you ever fired? Were you ever right-sized?
Luckily, I was not at a bank where this was necessary, though during the financial crisis, nobody was really sure if you're going to lose your jobs. And the banks cut down tremendously, especially in Europe on jobs. But luckily also I'm in Germany, and Germany has very tough labor laws. So it needs a lot to get fired here in Germany.
Let me cut to the chase on thousands at Credit Suisse. They really have to speak to Swiss authorities. Does that mean the layoffs will be much greater in London, in New York, in Hong Kong?
Yeah, absolutely. I guess so, especially as Credit Suisse or UBS is looking to cut the investment banking, and those activities are naturally more in those cities and not so much in Switzerland. But overall, I mean, this is not very surprising. Remember, we spoke about when Sergio Motti said, he's looking for massive cuts, and we pointed out that this usually means 50% or more when the CEO says something like that. And now we got kind of confirmation for that. It makes total sense for UBS. They need to present some success in this very difficult merger very fast. They need to get down costs. And what's easier than that than to cut jobs as hard as it is for the people involved?
Let's put some numbers to this. That UBS intends to ultimately reduce the total combined headcount by about 30% or 35,000 people. This is a lot of people, a lot of jobs. Do we have a sense, Jan-Patrick, of just where we are in terms of who has stayed, how much of the talent they have lost during a process that has been absolutely scathing in some of the commentary?
But it's very hard to get into the details about the talent who really is on the ground floor, on the working or the front line, who is really the big talent that they have lost or that they keep. We know of some managers that had left, but that is normal in such a takeover. I think from the perspective of UBS, they look at the whole merger right now and think about okay, what do we want to keep? And then we cut all the rest. And what they want to keep is some key people in the wealth management who have unique client bases that are adding to the pool of clients at UBS. They want to keep some key talent in deal making where they have maybe gaps and stuff like that. But what they definitely don't want to keep is everything that is back office, everything that has to do with stuff that can easily be scaled. You don't need another 100 traders to trade you bonds and stocks. The traders you have already can easily do this, especially with the level of technology today. So all these, let's say, easy replaceable double positions will be cut off, and that will go rather fast. That's why we are hearing that a big majority of these job cuts will even happen this year.
When will we get stability in this combined unit? And I say this at a time when not only are there potentially 30,000 planned job cuts, but also we're hearing about ongoing withdrawals from the Credit Suisse unit.
Yeah, absolutely. That's a difficult question to answer, I would say. Like, definitely not this year. I'm very skeptical about it even for next year or even for 2025, because the thing is, like, we get like probably like more stability, I would say, but the absolute stability is still a long way from here, because we know like these big mergers, it takes forever. And then when you have solved one issue, then probably another one comes up, and we don't know what the market will look like. How will client sentiment behave in the next 1 or 2 years? So this is all going to be figured out. The outflows will probably not like happen once, but will be gradual from those clients who feel like that they have to split up their money if they have been a client of UBS and Credit Suisse. So looking for real stability here, that's a very long-term goal. It won't happen fast, but I guess like that we will see much clearer by the end of the year how the bank will look like and how the further steps will look like.
We've been talking all morning about the 9:30 a.m. Eastern panel in Sintra with all the central bankers of the major economies coming together and talking about their plans. We've been hearing about members from the ECB as we came into the segment, potentially raising rates several more times, even after getting rates to the highest levels going back decades. How will that affect a combination, a merger like this? How will this affect just the banking sector in general, that this is actually a positive development for, but it's happening very quickly?
Yeah, absolutely. And we have this like contradicting or in opposite pulling directions factors here for the banking sector. On the one hand, of course, we have like, especially here in Europe, coming out of this very low interest rate regime, which is like increasing net interest margin by a lot for many of those European banks. On the other hand, we still don't know how deep the cracks in the real economy will be in Europe, how badly the refinancing of companies will look like, and how will this affect credit quality going forward. So it's very difficult to say how this is going to play. And I'm not sure if we have seen like the wobbles we have seen in March. I'm not sure that has been the end of the banking story.
All these people laid off, what will they do? Where will they go?
That's another very difficult question, because in Europe, again, we have the theme of like reducing job cuts, reducing headcount for over 10 years now. And of course, there will be some banks who feel like, well, if UBS doesn't like that business, we are keen to take it on board. It fits well to us. And maybe they hire a team here and there, hire individual people here and there. But for the majority, I don't think there's much that other banks are keen to take on board here. And that also means like that for those people who are losing their job, it's not going to be an easy time to find the same job at a different bank.
I mean, very quickly here, we had the CFA results yesterday, people doing better out of the pandemic on the level 1 exam. Are fancy, educated people in the global Wall Street business, are their days numbered? Is it generalization, or is it just tougher?
No, I wouldn't say so. I would say it's tougher. But I guess like smart people have a good education and who are willing to switch their career path and say like, okay, if trading doesn't work anymore for me in whatever shape or form, then I'll do something else with my brain. I guess they will always find a job. It's just like going to be different, and you have to adjust your life for it. That's for sure.
Yeah, I'm Patrick Barnett. Thank you for the brief. Just really something. Lisa, it's a frightening thing. I mean, you talk about obsolescence. Are all these fancy jobs obsolete? Because this is not just about Credit Suisse. You mentioned the numbers. It's on. I guess it's what it is. It's a bankruptcy merger. Just to make a long story short, but every other bank is doing the same thing on a more smaller basis. I mean, you really wonder here. You say to a kid, "Go get a CFA. You'll love it." I'm serious. I'm talking my book, but
At the same time, you have stories like the one that came out yesterday about how interns on Wall Street are making $120 an hour if they work at Citadel. Yeah. So, it's sort of what talent. And this goes to the point that Gina Rometty was making, which is that when we talk about artificial intelligence and when we talk about some of the rapidly changing backdrop for technology, how do you train people to keep up with that in a way where it can augment their abilities, their knowledge, their past, rather than make them obsolete? And I really do think there are still people getting hired. We talk about that all the time. But there are changing roles within Wall Street and more broadly within the labor market.
Pulling out the Bloomberg HP 12C calculator. There it is on TV. You can see it there. It's on my phone. Lisa, intern, 55-hour work week. $6,600. Yeah. So you're popping 14 weeks at the shop. That's $92,000 by Labor Day.
Yeah, I was talking with the offspring last night, and how young is too young to get a job on Wall Street? I was like, please, just finish your homework.
Jean-Patrick Barnett there from Frankfurt. He's really been helpful on the travails of Credit Suisse. Red and green on the screen. Sintra in the 9 o'clock hour. This is Bloomberg. Good morning.
I think it's just going to take time for people to get used to higher rates.
5.25 is enough. I don't think we need to go much farther than that.
If we're going to have a recession in the second half of the year, it's going to have to come from the consumer side of the market.
Economists have us starting a recession in just a few days in the third quarter. You don't see that in the earnings forecast.
The Federal Reserve has basically told us the only way out of the inflation conundrum is to have a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television, on a most interesting Wednesday that we have. Not much economic data this morning, but maybe economic discussion in central Portugal. We had Francine Lacroix yesterday with Guy de Gopinath, and today we'll have Lisa Abramowicz with the governor of the Bank of England, the governor of this, the governor of that, and the chairman of the Federal Reserve System. It's an annual event. It's going to be interesting what they do say, and also interesting, Lisa, what they don't say.
And how divergent their messages are. It is not going to be me on stage with them, just to make it very clear. I will, however, be watching it and we'll be showing it. To me, the question really is, do we get some greater hawkishness than we've already gotten, which has been pretty uniformly, putting aside the Bank of Japan, hawkish? How do we then translate that into a market that's been already hearing that? Have we already priced it in, or is it going to get repriced, Tom?
And the repricing, well, off the data screen this morning, to cut to the chase, it's pretty quiet out there. There's some little niceties, but it's pretty quiet out there. To me, I'll be fascinated how the three of them talk theory and monetary ecobabble, with the one guy, Bank of Japan over here, it's like Sesame Street, folks. One of these doesn't fit with the others, whatever the phrase is. I mean, the Bank of Japan is the outlier here.
Well, they're going to continue to say that yield curve control is important, even as we see the expected inflation creep up. I believe the expectation is for 3.6% at the latest read. And they're looking at keeping rates near zero at a time when you have the Bank of England really fighting inflation in a very different sense, in a much more significant and painful sense. And the ECB doubling down, possibly 2 more rate hikes. How do we really factor that in at a time when we never thought that they could get beyond zero?
For Global Wall Street, we've got a really important guest coming up, so I'm going to get to the brief. And first, the data check. Red and green on the screen. Futures at -5. The yields are in today. I mentioned some interesting data points. I'm going to cut right to it. The 10-year real yield suddenly signals a stickiness to inflation, 1.55%, not through to a breakout to a higher regime of an inflation-adjusted yield, but nevertheless buttressed up at 1.55%. And the other is China, 7.25 print earlier, 7.24. A very weak Chinese yuan, and this is Chair, look at me, Chair Yellen. Maybe she'll be at the panel today as well. The Secretary of Treasury will travel to China here at some point. At least I butchered that data check.
A lot of crosswinds there. As you were mentioning, 9:30 a.m. really is the main event today with the panel in Sintra with the 4 central bankers, the Bank of England, the Federal Reserve, the ECB, as well as the Bank of Japan. We will be seeing if there's anything that comes out of that. 4:30 p.m. We were just talking with Sonali Basak about this. We do get the stress test released by the Federal Reserve. Tom thinks that they're a snooze fest. I personally think that it's going to be fascinating to either put to bed once and for all the concept of a banking crisis or reignite concerns about what the Fed is looking for in terms of a crisis. Tom, we can talk about that and debate it. I think it's important. And after the bell, Micron is reporting earnings, and this comes at a time where, in general, the chip makers are selling off after President Biden indicated that he was going to crack down and harden some of the export restrictions for AI-related chips. This is fascinating to me. I know this doesn't seem like the main event, but to me, given the leadership in the market so far this year, this is a major issue.
It's going to be interesting to see, to say the least. Lisa, on the earnings front here, when we've said it's going to be a very different quarter, and we start early with Walgreen Boots Alliance yesterday and Delta. Generous Mills, GS, out with a dividend lift, a 9% dividend increase, positively European.
Well, yeah, although interesting to see that we're not necessarily getting the reaction that one would expect. The share's down 3.5%. So even though they beat expectations, This, to me, is the question.
Yeah.
Well, then why are we not seeing a better response?
Organic net sales, and maybe this is the shift, Lisa, that we're going to be listening for, where a lot of the good news on earnings was from price increase, inflation, the generous lights of inflation helping at the revenue line versus unit dynamics, how many boxes of Post-Toasties or cornflakes for their competition were sold as well. Right now joining us is Wei Li, Global Chief Investment Strategist at BlackRock. And there's always 14 things to talk about. I really want to lead with Secretary Yellen into China and what China means within an investment strategy. But I got to rip up the script here. There's a guy named Fink who's talking about something BlackRock has led on. You've been directly involved with this, which is the value, the efficacy, the usefulness of ESG. Larry's come out as a real proponent of talking about it and said it's been a challenging time out of the pandemic. Color for us how you are reinterpreting ESG right now within your investment strategy.
Well, sustainable investing is investing, right? We're incorporating considerations around the impact of climate in our capital market assumption. We're also thinking about how the transition could look like and really thinking about how that then is reflected in portfolio construction, to what extent it is really in the price. So as we think about transition as one example of mega forces, what we're doing actually in this media outlook that we're releasing today is that we're prominently highlighting a few mega forces, including sustainability and transition to net zero, but also including geopolitical fragmentation, including aging demographics, including AI, to really incorporate those mega forces in portfolio construction.
As you put the review out, 2 days left in the first half of the year, what changes for you in terms of your positioning after 6 months of being really cautious?
Well, I think the biggest change is as we think about kind of the environment where yields have risen, is that we're actually within fixed income excited about opportunities across the spectrum. So we have been talking a lot about front end of the curve, which we still like, but we're actually also putting cash to work across the broader exposures in fixed income, including MBS, mortgage-backed securities, including inflation-linked bonds, especially in the US, and also including high-grade credit and local currency emerging market debt. And more broadly, as we think about what has changed, we're rolling out the new investment playbook where the first layer is around macro-based asset allocation, but macro can only take us this far in this environment of supply constraint. So we're also thinking about having the second layer of very granular, uncorrelated, individual investment opportunities to overlay on top of the first layer. And then the third layer is the mega forces that I just talked about.
Where is the idiosyncrasy of artificial intelligence in the overlay that you talk about?
Well, so far, if you look at markets this year, it's been a very narrow thematic markets, right? So that has taught us that just base asset allocation on macro assessment alone is not enough anymore. So far, we have talked about a bias towards quality, a tilt towards quality in our U.S. equity allocation. But what we're doing differently at this media outlook is to break that out and explicitly call out a conviction in developed market AI, which we have had indirect exposure towards, but now we want to call them out explicitly because the interplay between the cyclical framing and the structural mega forces is so complicated and nuanced that we cannot afford to muddle them and mix them up together.
Your essay and outlook here is a view from 60,000 feet. It is very macro. It is very big picture. And in the middle of it is a massive micro reality. You say that the pandemic supply constraints that have affected the world will have a persistency, that they will be permanent in some way. That's a stunning statement. Why can't we get back to supply-demand normality?
While some of that supply constraint is pandemic-induced, but a lot of that is getting washed out in terms of the cyclical pandemic-induced supply constraint. But what we are putting out, which we have been of the view for a while, is that we're moving away from the last 30, 40 years of great moderation characterized by demand shocks to the current environment characterized by supply constraint coming from structural forces like the net zero transition, like geopolitical fragmentation, and also aging demographics. And what that means in the context of this week being the Sintra week is that when it comes to central bank policy, during the great moderation, because of the structural disinflation, they were inclined to keep policy easy and come to the rescue.
They had a free lunch for 15 years.
That was easy. And then now they're in an environment where they are actually, they need to keep policy tight in order to lean against this inflationary pressure.
Mathematically, what we've got here is we finally got to return to a risk-free rate. We've got a legitimate Sharpe ratio, without question. Some of the traditional dynamics you and I studied in books. What does that mean for the Sintra panel today? What are you going to listen for from these people about their new reality, which is a reality from 17 years ago?
Their new reality is the reality from maybe even 30, 40 years ago, right? Because the great moderation is over, including the period after after the global financial crisis. So what I will be paying attention to is to understand if they acknowledge the trade-offs facing them, which is that the cost of fighting inflation in a supply-constrained environment is a lot higher. So if they acknowledge that, and also number two, what are they going to choose when faced with this stark trade-off, growth or inflation?
There was a real tension when you were speaking. Is there a possibility for markets, for U.S. equities to rally, even if we do get a recession, and even if the Fed does become very hawkish, and we get that? Is that what you're saying, that you could still see the market respond in an untraditional way to a central bank-induced slowdown?
While U.S. equity markets currently, the broad market is still pricing in earnings to accelerate in the second half of the year, which in the context of growth slowdown is too optimistic, which is why as we think about asset allocation for the broader market, when it comes to U.S. equities, we have a -1 out of a scale of -3 to +3, and translating that into portfolios, global portfolio, U.S. equities, the benchmark is around 33%. This -1 modest underweight translates to about 31%. So we're invested, but we're modestly underweight. Right. Now, having said that, there are themes that we would like to embrace, such as artificial intelligence. So we kind of add that on top of the broad market underweight, modest underweight, to get to closer to neutral, but not quite there, which is still modest underweight.
Whaley, thank you so much. With BlackRock. Right now, S&P futures down fractionally 0.1%.
That was fascinating, Tom. What Whaley was just saying there really just struck me as highlighting the difficulty in coming up with something completely macro without taking into effect some of these other issues like artificial intelligence, like what companies are going to benefit from deglobalization, reglobalization, whatever you want to talk about. To me, how much is this going to be the new playbook that might harken back 3 or 4 decades earlier than the one that we've gotten used to with such central bank dominated action?
And not that history will repeat itself, but I would take the macro dynamics that we just heard from Wei Li, and I'd overlay it with the micro Chicago dynamics of Jeff Curry that we heard from Goldman Sachs, where he said, look, everything in hydrocarbons now is still based on the new reality, which is a legitimate real yield, a return to a legitimate rate structure of some time. Granted, there's massive curve inversion now, but the macro structure of BlackRock is adapting to the end of the great moderation. That's a huge macro theme for us for the next 6 months, if not a year.
And it causes some micro headwinds and tailwinds. And that's sort of the underpinning here. When you also have real invention. You actually do have new realities with relationships geopolitically. How do you interplay the idea of the end of financial repression with some of these new trends that are very real and causing real market reaction?
Are you going to buy the virtual reality thing from Apple? Is that going to be the new technology?
At home, there are people in the Bramall house that say this is the future of computing, and if we don't buy it, we are going to be behind. And I say, go get a job, and then you can pay for it yourself.
I just wish we had boys so we could worry about this garbage. They don't care. We don't care. Red and green on the screens. Stay with us. This is Bloomberg Surveillance.
What we've seen in the actual data has been a lot of resilience. We've actually seen that stretch of a strong labor market improve due to the very large increase we've seen in participation of working age Americans. And so there are reasons to think that we are going to continue to see resilience against a backdrop of what we have referred to as more stable economic growth.
An optimistic tone taken by the National Economic Council Director, Lau Brainerd, formerly of the Federal Reserve System. She's getting a little more visible over there to say the least. How about on the chances of a U.S. recession? At the White House press briefing, the president echoing Brainerd's comments at a fundraiser saying, quote, "It's been coming for 11 months. Well, guess what? I don't think it's going to come. I watched Bramo, and Biden says it's scheduled. You know, he's going to give another speech today at 1 p.m. after Sintra. I mean, this is good news for the White House, right, Lisa?
It is good news for now. And the tension right now is that if he gets a recession now, he could clear it out by the time he runs for re-election. If it comes around that time, it is more likely that he will be a one-term president. So if we have just simply excised any kind of downturn from the equation, well, that's good news, Tom, unabashedly.
Let's take on this trend now of our economics. We'll try to get to Russia with Amory Horton, our Bloomberg Moscow correspondent. And joining us from Washington today, as always, of course, the star of Balance of Power as well. Amory Horton, I look at the good news in the economy and is out in the Washington zeitgeist this morning. Why is this administration having so much trouble selling their success?
Well, the issue is the American people just don't feel it. When you look at poll after poll, Biden continues to get poor remarks in the economy because of high inflation. Remember, Biden said that he thought inflation would be temporary back in 2021. But then, of course, Americans suffered for years higher inflation. And while Americans are having a lot of jobs, we see a very tight labor market. You don't always feel your neighbor getting a job, but what you definitely feel is higher grocery bills,
Right.
higher hotel bills, higher plane bills, and this is why this has been a struggle for this administration. So what they are trying to do is get back this term Bidenomics, which I think became first from a Wall Street Journal editorial months ago. And what they want to do is frame it in their own terms. And I've asked a number of them, how would you define Bidenomics? What does this actually mean? And what they're trying to sell is all the legislative wins they've had. And really, I think it comes to the core about expanding the productive capacity of the United States. What they want to do is make sure they are investing in hard infrastructure, in chips, hundreds of billions of dollars, and things like clean energy.
Right.
Their biggest issue is that when all of these projects come to fruition, it is not going to be in time for the presidential election in November of 2024.
Amory, I think of the zeitgeist, besides the return of Aaron Judge helping out the Yankees, in the late June zeitgeist here, there's a clear understanding of the polarities and subsections of the Republican Party and how Mr. Trump is still doing so well in the polls. I hear basically silence on the left. What are the polarities and what is the key constituency right now voicing Democrat politics with their incumbent president?
Well, they're rallying behind Joe Biden. Many Democrats still believe that this is an individual that can, if it was going to be a rematch of Trump versus Biden, that Biden would still win. What is concerning to some, and potentially this concern will grow, is this latest Morning Consult poll yesterday that showed that actually for the first time in a poll, Trump could beat Biden. That is a concern, but at the end of the day, they are all still rallying behind the current president, and they do not have anyone that is out there looking to also get in this race. There are potentially people waiting in the wings, like some certain governors, if the president decides he will not run. But at the moment, he is planning to take on 2024, and that is exactly why they realize their low marks when it comes to the economy, why they're going on this huge effort with this speech today in Chicago, and this will continue to frame and talk about
the economy and labeling what they see as Bidenomics.
Meanwhile, when domestic politics get overcome by geopolitics, and that's something that we've been trying to put against each other all morning, talking about Treasury Secretary Janet Yellen heading over to China at a time when the U.S. is coming out potentially with more strict requirements on not exporting high AI-related chips to China. Why now? What is sort of the push-pull right now of greater diplomatic actions paired with potentially more restrictive export bans?
Well, this is going to be the tightrope that Secretary Yellen has to walk. And this is a scoop from myself and Jenny Leonard that she is going in early July. Also, at the same time, the administration is ramping up their work, not just with the Wall Street Journal's reporting about export controls on some of these chips needed for generative AI development, but also on the outbound investment. They have a goal and an aim to try to get that done by the end of July. Very awkward conversations, I would say, for the Treasury Secretary as she makes this inaugural trip in that position to Beijing to meet for the first time her brand new counterpart, Chinese Vice Premier. This is a new individual, He Lifeng, and he was given this job in March. What we're seeing is the U.S. trying to do both. They want to make sure they have this open dialogue with China, but at the same time, they are looking at this competition and putting restrictive measures on some of these very high advanced applications that are needed for things like AI. Everyone is talking about the fact that AI is going to be a massive race between China and the United States. We have a story out this morning talking about the fact that many in China do see themselves behind. When you look at the money that's used in AI, the United States absolutely dwarfs China. But when you're talking to people in China, what they say is that, yes, they're behind, but they think they have the capacity to catch up.
Just quickly here, Anne-Marie, dovetail this back to the domestic politics of the moment, the idea that in general, people want to see more hawkish rhetoric around China. That has been what has appealed to voters in the U.S. How much do we expect some of the bans and the hawkish rhetoric to increase heading into the election season?
Oh, it will for sure increase as we head into 2024. Every candidate is going to have to come out when it comes to foreign policy and make remarks regarding Russia and make remarks regarding China. We've seen some of them already stumble when it comes to Russia and have to backtrack. I think it'd be very difficult to see anyone stumble when it comes to taking a harder line or as hard line as they could when it comes to Beijing.
Emery Horton, thank you so much. Greatly appreciated this morning, our chief Washington correspondent. Look for balance of power tonight, including a briefing on the events from Russia as well. Red and green on the screen right now. The 10-year yield, 3.74%. Chris Verone, really shocking there, up 4%. You wonder what that'll do to the economy. Torsten Slok, every day putting out a chart. He puts out like a single chart every day. And I would say they're always brilliant, but about every 1 out of 8 or 9, 10 days, it's like, are you kidding me? He just put out an "Are you kidding me" chart. I've just barely looked at this, Lisa. Weekly bankruptcy filings. There's a 4-week and a 12-week moving average. We're almost back to 07, 08. I had no idea.
What it shows is that the 4-week moving average, when you look at it on a weekly basis, the bankruptcies are ticking up much more quickly than when you look at a longer-term rolling trajectory. What this signals is things can move fast. The economy could roll over in a much more rapid way. And you know, not saying that that's what's happening, but that is the tone underneath some of the pessimists out there, some of the bears saying, just wait. Things can turn very quickly. Whether that's the case or not, whether this is micro data that points to one reality and paint the narrative that you want using data that points to better than expected consumer sentiment or a housing market reviving, either way, this is the nature of how people are parsing the data to try to understand the true story.
And what's interesting is I don't think we'll hear this today at Sintra. I think the fact is we have theory and analysis, like we heard from Wei Li, which is wrapped around one aggregate idea. Well, there's not an aggregate America. To be kind, there's Torsten Slok bankruptcy America, and there's somebody figuring out how to get on a Delta flight to Paris, but it's sold out. I mean, it's like two Americas.
And one inflation number that they are heading after, a very difficult time for them.
Stay with us in the 9 o'clock hour. Sintra, Lisa Abramowicz will have that for you. This is Bloomberg. Good morning. Bloomberg surveillance. Oh, you should have the cameras on while we're on break. Lisa Abramowicz discussing with us. Benevolent she's been with Mrs. Abramowicz Sr. over the years. You had to be here to see it. We should do that. We should big little, like the sports games do.
Yeah. Then I think we'd probably restrain ourselves a little bit more. Maybe not.
Probably we would. Let's do a market check and save ourselves. That's how you save yourself on Bloomberg surveillance. Look at equities, bonds, currencies, commodities. I'll try to be as good as Karen Moscow on Bloomberg Radio. Red and green on the screen. Futures in -4. The yields 3.74%. Yields are in a little bit, but it's been that range that Chris Ferro was talking about earlier. He models out a 4% yield. We're distant from that. Oil really has my attention. We are under $68 a barrel, and critically on Brent crude, we're under $73. This is important. 67, 69 on American oil. Brent crude 72.24. You go down $3, you're under $70 on Brent crude. That would be the shock of the quarter. As well. In the currency space, Lisa, help me here. I got 4 pairs to look at for 4 central bankers on a paddle in Sintra, and I'm getting no love here from the markets. I'm getting no pre-sell here. Maybe sterling a little bit weaker, 126.97. Is that about what I got?
That's about what you got right now. A little bit of euro softness versus the dollar. But what we are seeing, hands down, the clear move is a weaker yuan near the weakest level since November 2022, as that nation tries to have a more controlling role in the economy, in markets, at a time when there are a lot of questions around what's going on there.
Lisa informing me this morning, hey, stupid, NVIDIA's out today. And that's what you're looking at.
Well, NVIDIA is in the news today. It has been in the news because it's up 187% year to date. But other than that, it's also in the news because the Wall Street Journal put out a story overnight saying that the Biden administration is continuing new restrictions on exports of artificial intelligence chips to China. This would very much concern NVIDIA, considering about 1/5 of their business is sales into China. Those shares lower by 3%. But this comes after a rally that has just been astronomical. To give you some perspective, their market cap was $351 billion at the start of the year. It now is over $1 trillion. What could this do to them longer term? Is this going to be a momentary blip or something structural at a time when this is still speculation and could be rolled out coming next month? AMD in that as well. Those shares lower by about 3%. Those are the two main companies that would get affected by some sort of restriction on this front. And I find this fascinating, considering that they are the leaders in this market. They are the drivers of a lot of the gains we've seen.
But to what Chris Ferro said earlier, they have to, Louis Giamatti great phrase, consolidate. It's nothing wrong with going up like a moonshot and then consolidating for, dare I say, quarters.
Well, consolidate is one thing if there is no change in the news. We saw artificial intelligence change the narrative. Yes. Now, do we see some sort of geopolitical tension change the narrative once again in terms of earnings potential? The other company that I'm watching is Micron, because they're reporting earnings after the bell.
Chip today.
To me, this is going to be a really important earnings report. This is the true test. Are we actually seeing the revenues and the sales to justify some of the gains that we've seen year to date? Micron lagging behind the others because it doesn't have as much of a focus in the AI tech, but those shares still up 34% so far year to date.
Price in unit on revenue, and I'm really looking at unit dynamics as we go into the earnings season of the banks, of technology, and of course of everything else. General Mills out with a dividend increase here earlier this morning. Right now, we increase our knowledge with Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Kathy, I'm just going to cut to the chase as well. Am I clipping a coupon, or can I dream of total return out the next 12 months?
Oh, I think there'll be some total return in addition to the coupon. I think most of what you're going to get is the coupon. But when I look at where we're priced now, I think that there's some room still for yields to fall. Not a huge amount, especially if the Fed continues to hike rates. We'll just seeing more and more curve steep inversion. But I think that there's some room, and especially if you go in the investment grade corporate bond space, there's a pretty good room for some spread tightening there and some appreciation.
Help people that haven't bought a bond since Nixon was president. What's the yield I can capture on a general vanilla IG piece?
So I look at the Bloomberg index, and
for that she can stay.
The corporate index, it's well over 5%. It's probably roughly around 5.3% today. That's not a bad yield to lock in. You probably have a duration of 6 or 7 on that, but that's not a bad yield to lock in on IG.
So that's a money market yield for 6 or 7 years versus 13 months. Or 12 months. That's the shell game, right?
That basically,
I did okay there?
That's fantastic. Basically locking in those
Go
coupons that maybe you can get today in cash, but you won't be able to get maybe in 3 years, considering people are expecting rates to come in eventually. Herein then lies the question of the Torsten Slok chart that we were talking about earlier. Bankruptcy is ticking up in a more substantial way, especially if you look at a more micro basis, a near-term type of time horizon. How does that affect the credit proposition at a time when people are not prepared for a wholesale default cycle akin to what we've seen in the past?
Yeah, it's a great question. So it's one reason we've been cautious on high yield, even though high yields performed very, very well because, the coupon and spreads have been pretty tight. But it's reason to be cautious on lower quality credit because we are in a global tightening cycle. We are seeing softness. Corporate earnings have not been all that strong, when you look at the broad economy. And there's certainly going to be, especially the further down you go in credit quality, going to be companies who are refinancing is costing them 2 times, 3 times maybe what they were previously paying in interest. And that's going to trigger some defaults.
Which really raises the issue of how long central banks plan to hold rates high and how that is so important at a time when a lot of companies have termed out some of their debt structures and won't have to borrow for quite a bit. When is the pain point in terms of a wave of maturities that have to be refinanced that could cause companies to actually have to pay the rates that we're talking about?
Well, you're already starting to see it on the edges, but again, lower quality companies that have to refinance frequently in the bank loan space, already seeing it there. You would probably have another 6 to 12 month time frame for higher credit quality companies, and we're not really worried about a huge default cycle in IG, but I think eventually it catches up, right? Eventually, especially if the equity market doesn't allow you to refinance by issuing equity to offset some of the increase in leverage that's been taken place over the last couple of years.
I look at the bond market, and Lisa's expert on the distress in the high yield place, and I remember the comfort of just owning corporate bonds. Are we ever going to get back to that where the street wants to own corporate bonds, or are we completely now beholden to a full faith and credit discussion?
Oh, no, I think we've seen a lot of demand, again, in the investment grade space. We've seen a lot of demand from institutional investors, a lot of the mutual funds, a lot of the pension funds, et cetera, looking at
Is there a shortage of IG bonds?
I don't think there's a shortage, but the balance is pretty good when you consider the spread is over treasuries is fairly normal in terms of historical averages. I would say we're a pretty good balance right now.
You mentioned a 6-year maturity. Is that sort of the center point tendency on a barbell strategy, or can you nuance that to 5 years or 7 years around the belly of the curve?
Yeah, I'd rather be a little bit longer on a barbell, maybe 7.
Like 20 years out so I can pick up 8%?
Yeah, there you go.
Okay.
Well, look, as we talk to
Sir,
people...
you don't want a 20-year yield.
No.
Sir, if I'm wrong, you're crushed. Thank you, sir.
We're 2 days away from the mid-year point in a year that has been full of dashed expectations in a lot of ways. People came into this year talking about a longer structural shift upward in inflation. Now we talk to an increasing number of people who say we are shifting back to what we knew before. It's just taking a little bit longer. Where do you stand on this at a time when we do see nodes of disinflation in certain areas, but reinflation in others?
Yeah, I would be in the camp that's saying it's just taking more time. It's very difficult to see that we have a global tightening cycle, higher cost of capital, and we have had a slowing economy. We have top line, goods prices falling. And it's hard to see that if the central banks continue to keep real rates high, that we're not going to see that inflation come down. I think it's just a matter of time. It would defy expectations. You'd have to have maybe a massive fiscal policy shift, and right now the fiscal impulse is negative, not positive.
And a lot of people will say, just look at the yield curve. It implies recession. It implies downturn. And then there'll be 10 people who will message me and say, it's broken. It's not actually telling us anything because this is a new regime and a new post-pandemic reality. How do you fight against that? The idea that some of these indicators are broken given a macroeconomic backdrop that's unheard of.
Yeah, I mean, look, it's complicated, right? And we haven't been in a pandemic in 100 years. And so I think, every cycle is very different anyway. But I wouldn't count on the yield curve being broken. I mean, all it really reflects is the market expects growth to slow, inflation to come down, and the Fed to ease down the road. That's really all it's telling you.
I mean, I look at bond allocation, in the heart of all of our conversations at a mid-year review is a reallocation of a 60-40 split. Are you and Liz Ann Saunders on the same page on what that split should be?
Yeah, we don't specify because
you don't
that's
do
a very
60-40.
This 60-40 to us is a good place to start for people, but everybody's allocation is going to be a little bit different. But this year, coming into this year with bond yields up, we think 60-40 is not a bad place for kind of the vast majority of people with a long-term time horizon.
What is the public doing? Are they buying the story or are they all in cash?
We have such a range of investors, but we have a lot of people still very short and in cash who are gradually starting to edge out now that yields have been more stable for a while. On the equity side, we have a lot of people interested in trading, and so there's been a lot of that, but mostly people are holding steady.
Kathy Jones, thank you so much. With Charles Schwab this morning, I think it's fascinating, Lisa, how the media's full faith in credit, or the drama of 8% oil debt that's going under, in something in the middle that's boring that clips a 4.5%, 5%, 6% coupon. Nobody ever talks about it.
Yeah, but everyone's buying it. I mean, if you've seen this flows into some of the investment-grade bond funds, people have just been piling in because it's the sweet spot. You get a little bit more, you lock it in for a long time, and who's going to deny the fact that Apple's going to be able to keep paying their bills for a long period of time? So this has been one of the sweet spots, which raises a question: how do we account for this potential wave of insolvencies, the potential credit distress that's implied by the tightening in conditions, as well as what we're seeing in the yield curve?
I get huge use out of the Bloomberg Total Return Indexes, the heritage of the Lehman and the Barclays series that Bloomberg has now. And I just wonder how you get price up, yield down on those indexes, how you break through to some form of real price recovery. We're waiting on that. We haven't seen the disinflation to get there. The VIX 13.80, Standard & Poor's 500, it's down 0.1%.
Yeah, and one of the key questions as you're talking about how do we get there is, well, if we don't get a recession, if we don't get a real wave in bankruptcies, then suddenly you could end up in a better than expected situation. And a lot of that's being driven by AI, but also other stories on the margins.
Right now, this from the Detroit News, serving Michigan since the last time the Tigers won 3 games in a row. Detroit surpassed Chicago, Chengdu, Delhi, and the rest of polluted America. It's back. This is something we haven't talked about. For our international audience, Lisa, we don't want this to move east, do we?
No, we're talking about the fires in Canada that are continuing to rage and continuing to cause bad air to percolate into Detroit, into the Midwest. You saw Chicago, some of those views
Windsor,
along the
Ontario,
river, around
north,
the lake.
Toronto,
It's also shifting to Europe. We've also seen some of those maps push the smoke all the way over to Europe. It's frustrating and it's scary because when you have to wear a mask and you can't exercise outside, it does feel something.
My arch question is, okay, so we've got this. We had it 3 weeks ago. It cleared. Now they have it. I guess it's coming this way, is what they're saying. Why wasn't it here last year or the year before? I mean, it seems, do you agree with me that it's sort of something new?
Well, this is the worst fire that they've had in a very long time. So it is burning more acres, and that's part of the reason why.
Really, really something. I just looked at the numbers that I look at on my app on my phone, and Detroit really front and center on this. The Canadian wildfire here, and as we suggest, maybe moving east, and we'll do a redux on this in New York in the coming days. On the American economy, on Chairman Powell, Kathleen Bostjancic, nationwide. This is Bloomberg. Good morning.
I would still stick with tech names. I do think that NASDAQ is getting a little bit overbought. If you look at the CFTC data, we're hitting new highs on NASDAQ mini positioning. That being said, I don't think you have to sort of throw all the growth stocks out at this point. A sector like communication services, where a lot of the internet names are, those earnings revisions are starting to weaken. They're actually staying stronger in tech proper.
Lori Calvasina of RBC Capital Markets there. Really interesting nuance. Her focus is mid-cap, small-cap, and sort of, I'll call it value-ness, not growthiness. And it's been a really interesting year reading Calvasina. To me, Lisa, what's so important about someone like Lori Calvasina is the dynamic week to week. You know, like a John Stolfus is the same way. Ben Laidler over at eToro. The dynamic, the way they change week to week is very cool.
And how much it relates to sentiment. At the beginning of the year, everyone was bearish. The world was going to fall. We were going to get recession. And Lori Calvasina has been looking at data, AAII investor sentiment data, that shows people are getting more bullish in their sectors that even look overbought. So even though she's positive, she's getting a little bit concerned about how heady things have gotten a little bit.
We'll have to see on that. Right now, we're going to dive into a conversation which is really interesting. It can be a nerd fest, and we're going to try to avoid that. Mandeep Singh joining us now with Bloomberg Intelligence. And I want to talk the substrate of it all, Mandeep. I'm old enough to remember, Mandeep, that the way you started a cocktail hour to talk about your world was somebody would walk in with a substrate cylinder that would become silicon wafers. This is an IBM patent from years ago, coming off MEMC son Edison, ancient technology. And am I right in the NVIDIA world, Mandeep, that the wafers have just gotten thinner and thinner and more productive and more efficacious? Is that true?
It is, and right now we are in that sweet spot when it comes to the product cycle for data center chip demand. I mean, really, a 40%, positive revision, what we saw from NVIDIA last earnings, is a reflection of just this profound shift that we are seeing, in terms of the refresh cycle as well as the new demand. But at the same time, you always have these negative news around sanctions and what it could do, because it's not a low probability event anymore in terms of what it could do to both China and market as well as the supply chains that are tied to it.
Mandeep, taking a step back, the Wall Street Journal reporting overnight that the U.S. was thinking about possibly restricting exports of certain AI-related chips to China, that this could come as soon as next month. NVIDIA would be among those most affected. How much would that dampen their market valuation? Let's just say this did go into effect. How much would that strip away from the nearly 200% rally we've seen year to date?
Well, so, let's maybe focus on the fundamentals right now. Clearly, the data center demand is everywhere, and it's across industries. I think what they did the last time around when sanctions were imposed, for one of their chips, is they came up with a low-performing variant. And the focus of these sanctions so far has been on the leading-edge chips. And so you can work around it. They've been very agile in terms of coming up with ways to, keep selling to that end customer that is in China. And as long as I think you don't see a material decline in their sales, they probably will keep working around it. But look, as I said before, this is not a low probability event anymore. And China risk is huge when you think about, the political cycle and elections coming up in Taiwan, in the U.S. I mean, this could escalate. And I think that's where investors have to be very, given the multiple expansion we have seen this year.
So what are you looking for? How do you play this, Mandeep? You said investors have to be very careful at a time when there is a lot of hope around AI and the promise of it. So how should investors be careful? How should they monitor this? How should they even understand what the tail risk could potentially be?
Yeah, so look at, the sales exposure to China. It's at least, 20 to 25%. And look, not all the chips are used by Chinese end customers, but you can think of, all the different SKUs that NVIDIA makes, especially on the data center side, that are more exposed to the sanctions. And if we have something like what happened to Russia in terms of, broader sanctions, that could be huge, especially for the semiconductor makers. And look, NVIDIA is not the only one. You will have the semi-cap equipments. That's a big focus for, sanctions. So clearly, they have to figure out ways to both diversify their supply chain can these chips be, assembled somewhere else outside of China when it comes to the end product and things like that? So the supply chains have to move quickly, and I don't think it's going to be as good for the pricing we've seen so far.
Mandeep, when I look at this industry, can we say that maybe like the airlines years ago, they've learned the value of persistent free cash flow and that they're more financially responsible than they were 10 years ago?
I think in the case of fabless chip makers like NVIDIA and AMD, I mean, they have a very robust free cash flow generation machine in the sense that, they don't have to invest huge amounts of CapEx in terms of the foundry side. But that's where the risk is, because it's so concentrated in Taiwan and Asia. Like you can't make chips. And look, there are others like Apple who are equally exposed to that sort of a scenario. So I think in terms of the fabless design makers, you clearly have a moat in the case of NVIDIA, and others are trying to catch up, but it'll be years before they can make that high-end chip. Yeah.
I don't mean to be rude, but if President Biden wants to build a chip factory in America to beat those dreaded Chinese, are those chips going to be the same quality as the chips in Taiwan?
Well, so you don't have the leading node capability right now, when it comes to 3 nanometer or 5 nanometer. And that's where these companies are somewhat constrained. They have the designs, but they can't manufacture it because we don't have that technology or that factory here. And over time, it will come. But, things change every year, 12 to 18 months when it comes to semiconductor. I mean, that's Moore's law, right? And so you don't want to be in a situation where you don't have the latest leading node chips available, because that is what drives the pricing.
Mandeep, just quickly here, what are you expecting to hear from Micron today? How important are their earnings given what we have seen in the run-up in chip stocks?
Data center exposure. So far, Micron has trailed because they have been less exposed to data centers. So how they are navigating around it, how are they participating in this AI, generative AI wave, that is what you want to hear.
Mandeep Singh, thank you so much. Greatly appreciate it with Bloomberg Intelligence. Lisa, thanks so much for that buy tip. 10 years ago on AMD, up 40% per year, 40% per year. Thank you for that.
Anytime. I try to help you out of the triple leverage all cash account. Here's a question a lot of people have, especially as we just heard Wei Li of BlackRock talk about how they're overlaying and embracing the AI theme. Where does the political risk come into play? How do you even measure it at a time when we are heading into an election? And hawkish discussions around China works, right? I mean, that's basically what galvanizes people and wins votes. Even if businesses say pump the brakes, we need to have some sort of other type of relationship.
I totally agree. And to me, the basic idea here, a la Mandeep, is, do you believe in the technological innovation forward wrapped around all this? I have never made money in semis. I've been a loser. There's an index of SOX, SOX, that this is not a measurement of the Red Sox mediocrity. And the answer is, I've never been able to make money on an index that's averaged 24% per year for the last 10 years. How can you do that? You can be as inept as I've been in the chip game.
Well, there are winners and there are losers, and the disparity between the two is vast. It's something you can run a truck through. This question around who are going to be the innovators, who are going to be the winners take all in a race that is very specific and that does have the NVIDIAs and the AMDs facing off versus the Micron and getting out way ahead of them. So, you overlay the political risk. How do you get in? A lot of people will shrug it off and just say you just need to own them.
Do you feel that it's sort of like the Apple's going to die discussion? I mean, only for 20 years, every 18 months on Q, Apple, they're done. It's never going to, it's just, they're so done.
It's, I think that if you take a step back, there are the people who say AI is going to save everyone. Other people say it's going to destroy the world and make humans obsolete. And then you have the people in the middle who are saying this is going to change how we do business. I already see it changing the way that my offspring do their homework, do their assignments. Not that they use it as a substitute for them, but that they use it to, figure out what the information is to be looking at, to grade what they're doing. I mean, they're using it as a tool in a way that I'm not, and I probably should be.
Can ChatGPT conjugate irregular French verbs?
Yes, it can do it a lot better than I can. That's all I can say.
That was my downfall, folks. Anyways, that was really interesting. Mandeep Singh there on the wafers. In 1 hour, we will consider Portugal. It'll be interesting to see. Joseph Amato, Neuberger Berman, important conversation. That's coming up. Bloomberg Surveillance on radio and television. Stay with us.
I think margin pressure is very real, and I think that's where the equity markets are going to begin a correction.
We're watching the margins really closely because inflation has been actually very good for margins.
We're in a nice downward trajectory in inflation. I think it will cool off on its own.
If the Fed has to keep tightening, eventually the economy is likely to crack, but we're not there yet.
Now, we're not expecting a ton more rate hikes from the Fed, but it does seem like one is likely.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Central bankers are back in the center stage, or maybe they just never left. Good morning. Welcome back. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, Jonathan Ferro, and Lisa Abramowicz. Jonathan Ferro is on vacation. He will be back next week, which is wonderful. This does seem to be the theme of the morning, that we are going to be hearing from central bankers at 9:30 a.m. in Sintra that include ECB President Christine Lagarde, Fed President Jay Powell, as well as the heads of the Bank of England and the Bank of Japan all together on stage.
Kit Jukes nailed it this morning in his 2-paragraph research note. He harkened back to 2004, 2005, the idea of the vortex of instability. And at that time, the bankers went this way and Trichet went that way. John's very big on this. My good friend Jean-Claude Trichet got this wrong. And the basic idea here is this a redux of what we saw before the crisis of 07, 08? And will we see someone today get it wrong? What's interesting here is the language issue. I wonder if some of the panel will be lost in translation because we have a new a banker for the Bank of Japan.
It's also coming at a fascinating time where we've had 6 months, people shifting their focus more to the individual companies, the individual micro trends, and less on central bank speak, saying they're following the same things that we're following. And suddenly, what we heard from Chris Verone is the exact opposite, that from here on out, it will once again be central bankers, it will once again be yields that will determine the trajectory of the market value.
Within the central bank space, it sounds like a range-bound discussion, as he mentioned, the 10-year yield being very range-bound, 3.73%. And you wonder, I'm not going to opine which way you break out of that yield, but if you break out of that yield, all of a sudden, that's a central bank issue.
Do you think they get along? Do you think they're friends?
The central bankers? You know, I really do. I've been a central bank watcher for years, and I think there's a huge collegiality to it because they realize, and the media does a terrible job of this, guess what? They put their pants on one leg at a time. Lagarde puts a scarf on. You know, these people are normal people wrapped around insufferable decisions.
News you need to know. They put their pants on one leg at a time. Let's save ourselves and take a look at what's going on in the market. We're looking at a bit of softness, a bit of retracing with it led by the NASDAQ after its reprisal yesterday. A bit of a pop. Right now down 0.4%. Largely on the heels of some of this chip news that we saw overnight, Tom.
Yeah, the chip news, I think, is the kind of thing that gets it going here. And, you know, a big day yesterday, a big short squeeze coming up here right till the end. And the levels here, 44.08 on SPX, Dow 34,000, NASDAQ still giving us a lot of love, and the VIX at a 13.80. I guess it's a bull market, but a lot of people don't feel like it's a bull market.
It's a moment of reset, and I think that really is the key. Looking right now at a 2-year yield at 4.73%, a bit of dollar strength. This has just been hovering around. You're right, Tom, to say there isn't a lot of direction when it comes to some of the crosses, except for the Chinese yuan, where you're seeing real weakness. And you are seeing just a shift marginally lower in oil, one of the linchpins of just this bet that there will be a slowdown in growth, particularly led by China, which does seem to be
Look at Brent crude under 72.
Yeah, and looking at WTI at $67.31. We are heading toward the mid-year level. We are 2 days away from that reset. And joining us now to help us reset is someone who is resetting in a material way. Joseph Amato, President and Chief Investment Officer for Equities at Neuberger Berman, joining us here on set. How are you, Joe, changing your view heading into the second half of this year?
Well, we've had an intense debate like there's going on in the market. And, our debate within our asset allocation committee probably reflects a lot of the dispersion that exists out there in the marketplace. We've got folks that are quite bullish and we've got folks that are quite bearish. But we went into the year expecting the economy to slow down at a more significant pace and earnings to be more on the disappointing side. And that really hasn't played out necessarily. So we went in underweight equities and risk assets. We moved up in quality. And that's been, so far the wrong call because markets have been pretty good the first half of the year, as you guys have talked about. But as we debated the issues and as it looks like any slowdown is probably extended and pushed out further, the earnings decline pushed out further, we felt neutralize our bet, sort of live to fight another day and see. We always have a chance to make that a change if we see earnings disappoint. But right now, we took that underweight off and still have a bias toward quality for sure.
So there's going to be more of an aggressive shift, albeit on the margins, heading into the second half. We've been debating all morning. What's more important? What happens with the individual corporations, or what happens today at 9:30 a.m. Eastern in Sintra with central bankers taking a hawkish tone? How much are they still in the driver's seat of what happens next?
Central bankers are certainly still very much in the center of debate around what's going to happen in the economy, given the challenges that they have in inflation. And you look at across the range of central banks, you have a pretty wide dispersion there as well. You have the U.S., which was more aggressive earlier on. Inflation's come down at a more rapid pace, although still we think will be a challenge to get down to the Fed's target. On the other extreme, you've got Japan, which maintains a quite permissive, if you will, monetary policy. And then, the UK has got a real inflation problem, so they've got to be more hawkish, and the ECB somewhere in the middle. So that's going to be an important issue that we continue to watch over the course of the second half of the year. What
matters right now? I mean, Neuberger Berman is priding itself on active management. I want to go into the history of what you accomplished with Lehman Brothers in a bit. But the basic idea here, away from passive active, is factor analysis right now. What factors matter into the end of the year?
Well, I think quality matters for sure, and profitability, because if we're in our broad allocations, think more up in quality, whether you're on the credit side or the equity side. I think you want to certainly be overweight that factor. And beta, you probably, in our view, you want to be underweight beta in that sense. Again, with a bit of a more defensive posture, even though we've neutralized our equity bet, again, we still lean toward lower beta, higher quality.
I look at where we are and a bull market unloved. Can you calibrate and see when a second leg of a bull market clicks in? I mean, there was 76, 77, which no one expected after the moonshot off of 74. Can you find a second leg of a bull market, or do you just have to go back to core fundamental analysis?
I think the level of dispersion that exists within the economy, I think, suggests we still need to do a lot of bottom-up analysis. As it relates to a bull market or where we are, it's been, the equity markets have been quite perplexing over the first half of the year because you've had a group of 7 extraordinary stocks that are up 50, 60%. That dominate the U.S. large cap index, as again, you guys talk a lot about. And then you've got everything else. And that everything else has been flattish to up modestly. So that's been a challenge if you're trying to invest and you see the index perform so well. Yet some of these, very few active managers are going to put 40% of their portfolio in 7 stocks, right, to be overweight the mega cap. So it's been, you feel as an active manager, you've been just chasing your tail over the first half of the year.
We're speaking with Joe Amato of Neuberger Berman, CIO for equities, over there at a time we are resetting into the new year and into the new half of the year. It feels like a new year. We've been talking a lot about some of the trends, and you said that there are a number of stocks that have dominated with 40, 50, 60% gains. I think chip makers. And then I think geopolitical risk and what we see this morning with a proposed plan by the Biden administration. Are you going all in on AI? Are you seeing this as a lasting trend that can withstand any geopolitical tensions? Or are you kind of being more tepid about it?
I think AI is going to be an incredible long-term trend for sure. I mean, that's going to be as profound as some of the things we've seen over the last 20, 25 years, similar to the internet broadly defined. But as we have seen with different technological innovations, you have sort of a boom-bust period, things consolidate, and then you have long-term growth. So I think AI is probably going to go through that, but it's going to be quite profound. I know from our firm standpoint, we're all in, we're diving in deeply in terms of how it can enhance our productivity and our investment insights. So it's quite important. At the same time, you raise the geopolitical issues, which, having just been in China, it's an issue that we're very focused on. It's an issue the Chinese are very focused on. And I think as it relates to AI, that's probably one of the most sensitive issues in the transfer of technology between the U.S. and China. I think it's going to continue to be an issue. You guys talked about it this morning in terms of potential restrictions on selling chips.
And now, folks, the most important conversation for global Wall Street to the end of the year. This is with Joe Amato of Lehman Brothers. I'm going to cut to the chase. There's blood in the street. Credit Suisse is throwing thousands out. Every other firm is throwing those fancy IB bankers out the door that you can't stand. You and Jack Rivkin built Lehman Brothers from 1997 to 2003. I remember looking at the sell-side analyst, the sheets rather. Lisa, this is when we had printed research reports. They got better every year until Lehman dominated the business, and Neuberger Berman involved in that, and all that. Is that a history of the past? Are we at a point now where we're taking the intellectual capital out of the business with all these layoffs, all this uproar that's going on in the street right now?
I don't think so, Tom. I think the fundamental bottom-up analytical work that helped propel us back in the day in terms of our own research rankings, or the work that we do today at Neuberger Berman, is still hugely important. You have different tools that you use, right? The bar is higher for sure. I think the sell side has underinvested in research over the course of the past decade or so.
What do you want to see from the big banks? If we were having a conversation right now with Brian Moynihan on the future of Bank of America securities research, what would be your counsel to Mr. Moynihan?
Well, I think the breadth of global research that these firms are committed to is important to us. We're a global investment manager, so there are a lot of parts of the globe, whether it's the small cap space or large cap for that matter, that have less coverage. Now, in some respects, that's advantageous to active managers because we've invested a huge amount in research. So the more inefficient the sell side is, if you will, the more advantage we have as a buy side firm if we're committed to research. But that said, we value quality research, and if it's provided by whether it's Brian Moynihan's firm or other large firms, that's super valuable to us.
Don't let the dust break with the Credit Suisse resumes coming in. Joseph Amato is at Neuberger Berman, the home of security research. The Dow, a little bit of a deterioration, down 0.2%.
Tom, we're talking, meanwhile, about whether there'll be a downturn. And one thing that we keep hearing, whether it's from Joe Amato or whether it's from Wei Li of BlackRock, there's a shift to a bit more bullish tone, a bit of a feeling that perhaps there is a change in the earnings. Maybe it's late. Maybe it's, you can't necessarily just simply say we're going to stay on our hands. The courage of getting in, that's sort of what you've been talking about, Tom, for quite a while. If the facts change, people's theses change, and the facts, particularly with corporate balance sheets, have been different than what people expected.
What people really have to do is say, okay, Charles Cantor waltzed in here in the vicinity of October, November, and painted an optimistic picture about selected corporations adapting and adjusting. That's been my theme for 18 months. Why does that end now? I agree it may be different. It may not be the moonshot off the October low, but you wonder how corporations will adapt and adjust. They will at the revenue line, particularly as the inflation drifts away.
Some of them will adapt and adjust. Others will go out of business. And this is sort of the tension right now, as we talked about bankruptcies picking up, is things are different when you start holding rates at this level for longer. All of a sudden, certain business models get challenged and others do well, which is the reason why some people are still concerned going forward, Tom, at a time when there still is quite a bit of lag effects that people have been saying are going to come to the fore any day.
It's going to be interesting to see the yield, 3.73%. Lisa's focused on oil, 67.40 on West Texas Intermediate. We're also focused on Portugal and Sintra in the 9 o'clock hour. 4 central bankers lined up in conversation. Stay with us. This is Bloomberg Surveillance.
There are new realities reality is the reality from maybe even 30, 40 years ago, right? Because the great moderation is over. What I will be paying attention to is to understand if they acknowledge the trade-offs facing them, which is that the cost of fighting inflation in a supply-constrained environment is a lot higher. So if they acknowledge that, and also number two, what are they going to choose when faced with this stark trade-off, growth or inflation?
On fire today. We're going to stop the show right now. Tom Keene and Lisa Abramowicz, Ferro on assignment. But this was really important. Whaley of BlackRock came out with a new macro view. That's what you do as you come to July 1st. And it was really, if we get the scenarios she set up, what happens to our world? It changes.
Well, she was talking about, right, the overlay of some of these big drivers, including AI, including some of the geopolitical tensions and how you play them. And she had been underweight. She had been cautious. She still is. But it's with an asterisk next to it about what to be cautious about and how to be not cautious in certain areas.
It reminded me sort of the Stiglitz globalization is over thing. Okay, well, it's a whole new world after all. 3 years out of the pandemic, 4 years out of the pandemic. Where are we in 2025? I hear sort of a deadline. And I'm glad that BlackRock came out with this study because we got to be thinking about 2025, 2026 in a whole new world after all.
Did you see the Jonathan Golub?
No, I missed this. Please.
Report of Credit Suisse coming out and saying that futures pricing.
Let's get young Golub on.
Indicates that there's no recession until 2026. That's when he sees it happening.
Far too optimistic, a toxic brew. John Golub there. Right now, we're Lisa and I are trying to waste time because this is the most painful discussion of the day they're going to have right now. Futures deteriorate, -10. The airlines. What is it about the airlines? Helene Becker joins us now, senior research analyst, most hated person in the world at TD Cowen this morning. Helene, I'm just going to cut to the chase. Who do we blame for this early summer mess?
So it's weather. And then there's the airlines who are prepared, but there's the government who's not prepared. So the airlines are doing less with more. They have more employees now than they did in 2018, but the government has fewer air traffic controllers now than they did 4 years ago. And this mess is going to continue for the next at least 5 or 7 years because the FAA doesn't seem to have a plan to resolve the shortage of air traffic controllers. We're supposed to have 14,000. We only have 11. I think something like 2,500 retired in the last couple of years. And the government was supposed to hire 1,500 this year, could only find something like 960 or 70. We expect about half that many to retire and half that many to wash out. So they're only going to net about 500. And when you're short 3,000, 500 into 3,000 is 6. So yeah, this problem's going to last for a while.
Helene, some of us of a certain vintage can remember staying in any great train station, South Station, Boston, Union Station in Washington. I spent a whole night once in the Omaha train station. And the trains used to be like people all lined up going in 8 different directions. Are we asking too much of the airlines to be like our train stations of another time and place? Is it too much to ask for Newark to be the old Penn Central?
And it's not. It should be. It should not have these problems. The airlines, the airports, I'll start there, are just bursting at the seams because demand is just so strong. United is forecasting that between June 30th and September 5th or 4th, whenever Labor Day is, they're going to carry 5 million passengers. And if you kind of extrapolate that out to American and Delta, it's probably similar. So that's 15 million right there. And then you add in all the other airlines, you probably have another 9 or 10 million. So we're looking at 24, 25 million people that are going to travel over the next 3 months, rest of June, 2 months, July and August. And the industry should be able to handle it. They have relatively new aircraft. You look at American, Delta, United, they've all been refleeting. Most of the other airlines, JetBlue, Spirit, Frontier, Southwest, they also have young, fuel-efficient fleets. And so it's not an aircraft maintenance problem. It's just that weather rolls in and the FAA goes on a ground stop, and instead of lifting it in an hour or half an hour, it lasts for 3 or 5 hours, and then crews start to time out. I mean, we still have the safest airline system in the world. So you add all that, and you add all these people into the mix, and you wind up with these awful delays and cancellations and unhappy travelers.
Helene, yesterday we did hear from Delta CEO at their annual meeting, and he acknowledged that business travel is still 25% below where it was pre-pandemic. Given all the roadblocks, given the expense, do you expect it to get back to the same levels that it used to be?
So, Lisa, yes and no. The typical analyst answer. So when you think about business travel and GDP, it should get back to, it should be the same percentage of GDP as it was in the past. And I think what you don't see is that people are just traveling differently. And from a corporate, like large corporate tech, for example, tech people from the tech industry haven't really come back. Financial services hasn't really come back. So from that perspective, we're not expecting it to come back, but we are expecting the same number of people to travel for work as we've seen in the past on a relative to GDP basis. But think about it, Lisa. We're seeing 2.5 to 2.7 million people a day travel. That's what we saw in 2019 with 25% more business travelers and 15% more international travelers.
And Helene, to that point, and just quickly here, there has been a shift under the cover of businesses using economy instead of business class because of how much the prices there have risen and companies trying to restrain costs. How much is that part of why the revenues for some of these airlines isn't picking up from business in the same kind of way?
Yeah, exactly. So businesses are trading down from business class to premium economies. And then people are using their own miles to upgrade into the front cabin. So we definitely are seeing that. And yes, Lisa, that's a part of it too.
What's your single best buy?
So our top 3 picks are United, Delta, and Copa Airlines in that order. Interesting. What's a United Delta distinction? So United's bigger in international markets right now than Delta is. United is about 50% international, 50% domestic, and Delta 60-40 domestic international. And the travel is really international this summer. So that's the difference. Helene Becker, brilliant. Thank you so much. Greatly appreciate it. I'll be thinking of you when I'm sleeping on the floor at Newark. It's that time of year, folks. It's that time of year where Abramo looks forward to the Hartsfield, Atlanta wait.
All right.
I mean, there's a plaque. There's a plaque in Atlanta that says the Bramo family sit here when you get stranded. Everybody's stranded. I sit at home and Mrs. Keene is on the phone to a lot of people, seriously, in airports, domestic and international travel, sitting there.
We were supposed to
It's ugly.
We were supposed to go to Puerto Rico as a family, and we ended up being delayed by 3 hours, ending up in Atlanta and not getting a flight to Puerto Rico. And so we ended up staying and having a vacation in Atlanta, which for the offspring was not incredibly wonderful.
And to cut to the chase, if you're not traveling rock star, the ramifications of, you and the kids, I don't mean you personally, Lisa, but anybody in the kids, you got to take the plane at 8 a.m. tomorrow, 6 a.m. tomorrow. And there's no like $400 or $800 or $1,000 check coming your way. Those days are over, it seems.
Correct. We're not going to be talking about that coming up on the Open. We're not going to be reprising my days of getting stranded in Atlanta, which will not be happening again. I was looking forward to the next week. Lisa Shallett of Morgan Stanley and Jack Manley of JP Morgan are going to be joining me.
Good.
Yeah, it'll be interesting, especially ahead of that Sintra panel, which is going to be the key event of the day, Tom.
It's going to be interesting. Really looking forward to how Christine Lagarde massages the message. This is Bloomberg Surveillance. Good morning. Nerdfest. Good morning, everyone. Bloomberg Surveillance on radio and television. Lisa Abramowicz preparing for the 9 o'clock show. Mr. Ferro's on assignment. There have been selected Ferro sightings. He's alive, he's breathing, he's tanned and rested.
That's a good thing. On assignment here in the British fashion is, futures in -7. Yields have come in nicely. And there really is, I'm not going to call it a recession worry out there, but I am going to point out 3 ideas very quickly here. The real yield, the 10-year yield of 1.55 gets my attention. That's an elevated inflation statistic over the last 3 days. West Texas Intermediate, Brent crude under 72, shocking. 71.85 on world oil, 67.26 on American oil. That bears careful study into the end of the week. And I'd also note Chinese renminbi gives it up again, rounded up 7.25 is a very weak Chinese yuan. There's economic data today. There's not 14 lines of economic data. There's 3 lines. It's sort of an off day, but we bring in the star. Michael McKee joins us in charge of important day and lesser important day economics. What do we got?
Well, if you're going to be an eco nerd, these are some interesting numbers. They're generally thought of as sort of secondary or tertiary, but they do mean something for GDP, and that is the advanced good trades balance falls to $91.1 billion from $97.1 billion. So a significant decline in the trade balance, which could add to GDP. Wholesale inventories continue their decline, down another 1/10. They were down 3/10 in April. These are May numbers. And the retail inventories are interesting. They come in up 8/10 after a 3/10 gain, which is revised higher from 2/10 for April. So we are looking at some additional strength for the overall economy. And the retail numbers are kind of interesting because they had worked them off over the holiday season into the beginning of this year, and now they're significantly rising again. Is that because consumer demand
let's
is
go
strong,
here.
or people are not buying?
And Kathleen Bashchansik with us a moment. We're going to have Mike McKee for the entire half hour to get ready for the Sintra Ballet. We're going to go nerd on you in about 15 minutes. But Mike McKee, this is important. I talked to Jan Hatzius once at Goldman Sachs about this. The media talks about inventories like it's apples in a grocery store or whatever. Let's dig into this right now. Retail inventories are up, but you don't know why they're up?
I haven't looked closely enough at it. I'm not a retail analyst. We should find one to ask.
That means there's stuff out there.
Yes, there's stuff out there. And is it because people have not bought their summer clothes the way they thought, or is this because we're starting to stock up for fall? But remember, we had a big rise in retail inventories during the pandemic because people weren't buying, couldn't get out, and then retailers had to clear them out, and now it's rising again. And all this adds, it gets counted into GDP, that which is at least made in the U.S. Okay. So we'll see what this means. But if you're calculating the Atlanta Fed GDP now number, which is at 1.8% right now, could go up a little bit.
Okay, this is important. And again, we're going to get to Bashchansik of Nationwide here in a moment. Tomorrow we get the third look at first quarter GDP. I'm going to editorialize that's a non-event. But the data you're looking at now is for ending June 30, right?
Right.
And you have a pretty good guesstimate of that, whether it's Atlanta GDP now or it's Kathleen Bashchansik at Nationwide?
Well, I'll put my money on Kathleen, of course. But
nice of you.
The GDP now numbers give you a snapshot in time, like a political poll, as of today, sort of. But there's still a lot of data to come. We're still getting this May data, and we're in June now.
Michael McKee with me for the half hour. And again, we'll really focus on some of the theories behind Sintra here. I think that'll be a huge value add to our global audience, that in the 9 o'clock hour in Portugal. But right now on this American economy, Kathleen Bashchansik joins us, economist at Nationwide Mutual as well. Kathleen, the data that comes out today, and we're getting near June 30th-ish, do you have a really firm grasp of where the American economy is Q2 ending?
Good morning, Tom. Well, I thought I thought Mike did a great job summarizing the impact of the data. Sorry, what we're seeing is on the trade sector. That's the biggest drag on second quarter GDP. So the fact that trade figures came in a bit better than expected makes less of a drag. So overall GDP growth now, I would say, and especially with putting inventories in the mix, probably over 2% annualized.
Interesting.
Q2 over Q1. Now, just to put that in perspective, because you are speaking about the central bankers speaking later today, Chairman Powell has said that we need to see several quarters of growth below potential growth. Potential growth is around 1.8%. So if we're coming in above 2%, it's not quite slowing enough for his liking.
What are domestic final sales? I've always loved this study. Define domestic final sales, and are they a recession statistic?
So domestic final sales is one of those core measures of GDP, and that excludes changes in inventories. And the reason you may want to look at that is just as Mike said, you don't know sometimes why inventories are moving. They could be intended, and that's a good thing. Like they think demand's picking up and they want to replenish their stocks because consumers are going to be strong and purchasing. Or it could be an unintended build, which is bad news, right? And they have to work those down because they have too many goods. So it's unclear at this point, how that works out. But we tend to like to look at final sales that strips out the inventory fluctuations. You could even take it a step further and look at domestic, right? And that takes out the trade sector as well, which could be very volatile.
Well, as long as we're talking GDP, let me ask you what you think so far. Yesterday, we got some news that suggested that businesses are spending money again, at least in terms of durable goods orders. And I'm not sure what you're seeing as far as consumers, whether the retail data suggests consumers are out buying. But what's your feel for domestic spending at this point for the second quarter? Is Atlanta giving us a pretty good idea of where we are, or are you much higher or lower than they are?
No, I think they are giving us a good idea where GDP is, and we're right in line with that. When you exclude the trade sector, you're looking at growth that's probably in the high 2%, right? Because the consumer got off to a very strong start at the start of the quarter. Now we'll get the May data on Friday, so that will be important. In fact, saving the best data for the end of the week, right before the holiday weekend, but consumer spending, income, and of course the PCE price index will be very important. But domestically, as you said, we're seeing the consumer still firing. I think that is feeding through to durable goods orders and business investment. Now it's still soft overall, the trend, and when you, especially when you adjust for inflation. But I think the consumer goods portion, that's really what's helping to kind of push a little bit of an uplift in an overall business investment.
Well, are you in the camp of a lot of economists saying that we're going to have a recession in the next quarter and keep pushing that out again? Or are you giving up on the recession idea?
Yeah, unfortunately, the timing is very, very difficult to call on this downturn. We have not thrown in the towel on the recession call. We have, based on the current data, I mean, you have to take that into stride, of course. And the fact that there's still a high propensity for hiring and consumer spending more than we had anticipated. But we still see the leading economic indicators and credit availability diminishing. And we still see that we've now pushed it out to Q4, so Q4, Q1 of next year. And we'll continue to watch the leading indicators as well as the coincident. But those leading indicators still are pointing to a downturn. So it's hard to just ignore that and say, okay, current data looks better. You don't want to forecast based on coincident indicators.
Kathy, to me, Nationwide's always had a wonderful clarity, sort of the fabric of the Midwest and Ohio and all that, about jobs in America. It's less 3 zip codes in Manhattan analysis, or maybe 1 zip code in Washington, 1 quadrant in Washington as well. What's your labor call in America with a central bank that's hoping and praying that Columbus, Ohio will have an unemployment rate that surges above 3%?
So, really, employment's been strong across the country. It's really hard to point at any particular states or areas where there is weakness in this labor market. The demand seems to be very broad-based. I think, the challenge for the Federal Reserve is they, of course, don't want to see a surge in unemployment, and they, of course, don't want to engineer a recession at all. But the real question is, if this economy continues above potential, meaning, running a bit hot, can you get inflation to trend lower? And I would say part of what we're looking at is the fact that housing starts, right, have started to rebound, and home prices have been up the last 2 months in a row. Well, everyone was banking in rental inflation rolling over. That could put a wrinkle in things. It could be that, home prices as part of the inflation measures it rolls over a little bit, but not as much as expected. So therein lies the kind of the rub right there.
Do you buy the rent disinflation story?
So I think that we're seeing some slowing in rental price increases. But what I worry about is that some of that's happening, but then it's going to level off and start to rise again, just like we're seeing in the overall economy, that this is, inflation and rental inflation is a lagging indicator. So if we're seeing the economy sort of, being resilient and even picking up a little bit, I think that spells trouble for the inflation. That means the Federal Reserve only has to do more. And that's why it's really tough to throw in the towel and abandon the recession call, even though we've been saying this for a while. I think the other point, just real quick, Tom, is that it's the inversion of the yield curve, and I think you and Lisa were talking about this earlier. There's very long and variable lags between when it inverts and we get the recession. But I think also what many of us were looking at was the degree of tightening. We went from basically 0 to 5%. That's the fastest tightening we've ever seen, even looking back at Paul Volcker's period. So it's not just the level or the inversion, but the speed by which interest rates rose.
Kathleen, thank you so much. Kathleen Bastiansek, a brief there on the American economy with Nationwide. Mitchell, Mike, we've got a bit of time here, and then I really wanted to fall into a nerd discussion on Sintra, something that you just excel at. But can we predict GDP? I think we all understand we can't predict recession. Maybe we can't predict inflation dynamics. Maybe we can't predict oil. Do we have any confidence we can pick GDP?
Well, it depends on how close you want to get, I guess. Economists are getting better because the data are getting better, and the government is releasing data on a more timely basis, especially things like trade. But these numbers do get revised, and that's where you fall into issues as better numbers come in. But now that we have a better picture of inventories and trade, it is a little bit easier to figure out what GDP is going to be within a couple of tenths. And then the big question is, what are consumers doing? Because there's so much of GDP.
70% of the American economy. Standard & Poor's 500 down 0.2%. And we say good morning to all of you on Bloomberg internationally and domestically as well, on radio and television, with a churning to the market. Futures -11, a bit of a deterioration in the tape in the last 30 minutes. 10-year yield 3.74%, gives me nothing this morning. I'm focused on oil. It's just a stunning number, particularly for those modeling out well above $100 barrel oil 12 months ago, 67.43. Down 27 cents on West Texas Intermediate. Brent crude's 72.01. This is going to be a joy. We're going to dive into this right now and really try to set you up with a value add for global Wall Street. Not so much on Sintra, which is sort of a Jackson Hole of Europe, but on 4 discrete nations with 4 different central bankers with 4 different outcomes, and we all have in our mind what they're framing out as well. And underneath it, there's supposed to be a theory that Bailey, Lagarde, Powell, and Ueda can rest their feet on. Michael McKee joins us now with decades of studying this conundrum. Are these 4 flying blind?
Not flying blind, but try to figure out past relationships and what they mean for current relationships is very difficult right now. And we've seen that over and over again in this pandemic phase. Some central banks have decided they want to hold back, and others want to go forward. And the differences have been kind of vast.
Yeah, well, we'll have to see. We're going to bring up this debate here coming minutes. I really want you to stay with us. It's going to be a real joy with our Michael McKee, head of all of our economic coverage. Futures at -11. This is Bloomberg. Good morning.
We're expecting a hike in July. We're also expecting a hike in September. The market is pricing that hike in July at to a pretty large degree. I think that July hike is a relatively low bar, and then after July we'll should see still some strong inflation data, and then that gets us to the hike in September.
A minor conversation today, but I'm sorry, a major impact from Veronica Clark of Citigroup. Is she and Andrew Hollenhorst just absolutely stay where people are heading. They have said that we're going to have higher interest rates and persistency and resiliency of an economy, as Lael Brainerd said from the White House, seems to be the tone here into the end of the second quarter. We say good morning, Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Bloomberg Surveillance, Ferro on assignment, Lisa getting ready for the 9 o'clock Sintra hour. And I have the privilege of being here with Michael McKee. His formal title is Bloomberg International Economics and Policy Correspondent. But the reality is, I go, Mike, remember that paper from 2 years ago on Nash equilibrium? And Michael will have it buried 6 papers down on his desk. He's actually the one that reads the papers in that. How is Sintra different from Jackson Hole?
It's a little different in that it is generally more focused on current economic issues. Not that Jackson Hole isn't, but Jackson Hole is an academic conference that focuses on topics in economics, where in Sintra they're often talking more about what's happening right now in markets, which is definitely something that they are doing. Sintra is also a little bit more open to the press in terms of having things broadcast, like this panel discussion that is coming up. At Jackson Hole, you get the chairman's speech, which has only been aired now for 2 years, but I expect will continue.
Maybe the panel will be longer than 8 minutes. I'm still got to get over. For Powell's speech, folks that don't keep score on this at Jackson Hole, was an outrage. Ferro, I think, was offset when we had to jump back on.
I think the introductions probably will take more than 8 minutes. With 4 people on the stage.
They'll be going, keep it up, please, introduce us longer. I'm going to go right to the Type 2 construct. What do they not want to say? Let's go right through them, starting with the Bank of England, ECB, Powell, and the mystery of Japan. What's the number one thing they don't want to say?
Well, you got to take Japan out of the conversation of the other 3 in the sense that Japan has its own economy, its own issues, its own inflation rate. Their inflation rate is going up at a time when others are going down, and they want that, and they want to make sure that inflation is going to stay a little bit higher. So their policies are different. Obviously, they're holding way down monetary policy very loose, and so they're having the negative impact on them is that the yen is weakening tremendously against all 3 of the other currencies. So for Ueda, he would be interested in not encouraging that move and seeing if the others actually can give us some indication that they are almost done, which is what the other 3 don't want to do. They want the markets to worry that they have more to come because they don't want markets to start pricing in rate cuts. And you and I were talking offline about the WIRP function on the Bloomberg that shows you what futures trading is predicting. And now we have added out another year. So you get a long look at what's in the markets. And while it's certainly not trustworthy because markets change their minds all the time, it shows big rate cuts in the U.S. in 2024. Still not in 2023, which is what Jay Powell has wanted and probably will emphasize today. But the markets expect those to come.
Kitchuk's nailed this morning by harkening back to 2004. John Ferro's been very good about this, folks, talking about not so much how Trichet got it wrong, but that the ECB took a turn pre-crisis of staying tight. All these people have a history or have been advised by their PhDs. Let's remember the mistakes that were made. What is the mistake that haunts these 4 bankers at 9:35 this morning?
Well, it's all kind of about the same time period. Well, it's about the same time period for the U.S. and the U.K. for slightly different reasons. Obviously, the U.S. went through the great inflation in the late 70s and 80s, and it came about because the Fed was too slow to tighten rates. And so Jay Powell doesn't want to make that mistake, wants to keep the pressure on. And the UK obviously had its problems in the 70s with inflation. And then after that, we had the sterling crisis. So they don't want to give up too early and have people start selling their currency. And the ECB's been through it, as you mentioned, with the Trichet tightening that then sent them into a bit of a recession and was a precursor, perhaps, to the great financial crisis at the time. So everybody's looking back, and the lesson they draw is that you have to have a policy and stick to it. And I think that that's the emphasis we'll get from them today.
This is almost like the anchored expectations argument. I'm going to look at one metric, folks, and this is American for our international audience, and this is something unique to America, which is a 30-year mortgage rate. Now, I didn't realize this legged up here in the last couple of days, 7.11%. What's the ramifications for these four bankers if, as Chris Verone said at the top of the show this morning, we do get yields to work higher on a resilient economy, on central bankers that feel like they have to raise rates? What's the ramifications for these central banks politically if we get a new higher rate regime?
Well, at this point, there isn't a huge impact on the Fed because the Democrats in office, Joe Biden, have a policy against criticizing them, and they actually think the Fed is doing a reasonably good job. Republicans will complain, but it'll really depend on how the economy is performing in 2024, whether they feel any significant political pressure. The British have a much greater problem because they have a much greater inflation rate, and they also have a different kind, as you mentioned, Tom, of mortgage rates, most of them much lower, and many of them are variable and much shorter maturity, and many of them are variable. So as they raise rates, there becomes the possibility of a mortgage crisis there. There's some feeling that there aren't that many resets coming in the near future, so maybe it's not a today problem, but it is something down the road. And the European Central Bank obviously has to deal with not just core inflation, which is a problem, but with the fact that energy is so important there. And right now, there are questions about what the energy supply is going to be next year, which keeps energy prices elevated a little bit.
I've got 8 ways to go here and not enough time to do it, Mike. I'm sure you'll be with Lisa here through the morning and with analysis of what we see at Sintra as well. But I really have to focus on the elephant in the room, which is under-discussed by me. I'm as guilty of this as anyone, and that is their balance sheets. You and I know there's a chart. Bloomberg has a beautiful chart on this, overlaying the balance sheet of these four banks, or critically summing them together into an unimaginable intrusion into the ownership of debt. The Japanese leading the way on this towards literally a liquid market. How critical is that debate right now?
It's becoming more important. It isn't the primary debate at the moment. For Japan,
it's certainly not the debate in the media.
Yeah, for Japan, it's going to be an issue because the government owns so much of the debt. As rates rise, it kind of constrains them. And I've talked to people in Japan who are concerned about what it's going to do to government debt rates. The UK has talked about selling some of its portfolio, and if they want to tighten in a sort of backhanded way, that could be something that they address. It would maybe help out in the mortgage sense because it would affect the longer end of the curve. And as I said, many British mortgages are set closer to the shorter end of the curve. The U.S. Is going to keep going at the pace it's going right now. They don't see any reason to change. They are looking for where they hit rock.
But does WIRP say rate cuts to come? I believe it does.
It says rate cuts to come next year, but the Fed said that as well. So you've got a reinforcement. I think the balance sheets, most people think the balance sheet will run up against the demand for reserves sometime in 2024, and we'll see them start to taper or stop running off the balance sheet. But nobody knows really where that is.
I've been remiss on this, folks. I'm really going to lean into this in July. I promise you in July this will be a study for us. Mike and I have avoided the elephant in the Sintra room, and that is Japan. And what I found over the years is every time you talk about Japan, you have to sell it to the Western media, sell it to the Western audience, and say, this is why Japan matters. Quickly here, why does Japan matter?
Because Japan is one of the biggest holders of U.S. treasuries. It's one of the biggest economies in the world. And so its imports, its exports, and its current account balance have an impact on other nations.
Mike McKee and I used to do this years ago, folks. Bloomberg on the Economy, Michael McKee and Tom Keene. This is a good and beautiful thing. Mike McKee, thank you for the briefing on Sintra here. We'll have that for you at 9:30 this morning. Lisa Abramowicz identifying the news flow out of these four central bankers. Futures deteriorate, -11. Good morning.